Hi there. Thank you for choosing to sign up with us and thank you for beginning this pre-scene journey with me. On this journey, we are going to help you understand our company, SoPa Restaurant, from the very start to the very end, and we will not leave any stone unturned. You just have to join me on this ride. You just have to listen to my explanations. You just have to note down the topics that I speak about. You just have to drink in this information. And trust me, you go through the pre-scene video 2 times at least. Part 1, Part 2, Part 3, 2 times at least. And then the PDF you can read at least 6 to 7 times before the date of your exam. Why? Because the pre-scene is a major pillar of your exam. You cannot write any mock questions or cannot think of what should be the next step for the company until and unless you know your company. The pre-scene helps you know your company. It's a major pillar to start on, and I will be focusing very much on the pre-scene in depth. You don't have to worry about anything. Just follow my explanations one by one, and you'll see that you're starting to understand the company. Plus, develop a solid list of important topics which you will revise on, and then we will test you on those topics within our mock questions. So it's a foolproof study plan. Don't worry, there's no ambiguity. Just simply start with this video, slowly follow my explanations, and you will understand everything you need to know about our company. For any questions, I am always available. WhatsApp group, direct message, email, anyhow, just reach me for any questions. I will be happy to help you. Let's start. Before we start with the pre-scene, CIMA has put out a little bit of an announcement. We'll cover that as well. So CIMA says that this case study is written in a very stable business environment. There's a lot going on in today's world, like maybe a war, inflation shocks, pandemics. There could be anything that's going on. You need to make sure that you treat it as business as usual. This company is in a situation where global disruptions have not affected it. So there are no global disruptions that you will assume. Everything is working like it's supposed to work. Everything is, free flowing. Only and only when a question tells you something, that's the theme that you follow. So in short, the question is what we work with. The question will give you everything that is needed, everything that is required, and that is the only information that we work with because this is a specific exam. So in short, treat the case study world as stable. The unseen information or the theme of the question will give you all the necessary details that you need. Let's start. Your role is the first section that we are starting with. So you are a finance officer working within the finance department of SoPa. So as we already know, in the operational level, the role given to us is that of a finance officer. Now, a lot of the times there is still some ambiguity about, okay, what is the role of a finance officer? Now, a finance officer's role is quite broad. You as a finance officer, you may be asked to help with short-term decisions, costing decisions, variance decisions, working capital decisions, budget decisions, IAS, IFRS related help. Now, if you look at all of the topics that I pretty much spoke of, you'll see that they are overlapping your E, P, and F syllabus. So to become a good finance officer and to do well on the exam, the starting point is your E, P, and F syllabus. That's your knowledge area. That is why we begin everybody on revision as the first step, because without this knowledge, you are not going to be able to do well on the operational case study exam. Now, your life is made very easy when you do this pre-scene with me, because I will be pulling out all the important E1, P1 and F1 topics for you. So my suggestion for everybody is, even if you're doing it by yourself, even if you're going through the pre-scene by yourself, have a list, have a piece of paper where you're making a list. When I go through the pre-scene, I will say, okay, this relates to P1 variances. So write down number 1, variances. Number 2, ZBB. Number 3, whatever topics are important, I'll keep speaking about them. So your job becomes to make that list and then make sure that the first thing that you revise is these topics. If you're studying with us, obviously we will give you the list pre-prepared. We will give you our Fin AI, which is trained on this pre-scene, so you will be able to quickly revise the concepts related to your company, making your life very, very simple. And then naturally, when we move to mock question writing, all of these important topics will be tested in exactly exam styled mock questions, and then you will be given corrections on them. So it's a foolproof study plan that we have created. Your job becomes to simply follow on and enjoy the ride, enjoy the process as we move to success. So, okay, the role of a finance officer needs you to have knowledge of E1, P1 and F1. It's just proven to you over here. You are principally involved in the preparation of management accounting information and providing information to managers to assist with decision making. So management accounting information, assisting in decision making, very clearly you are being told that P1 is the core of this exam, because everything related to management accounting, everything related to decision making falls in your P1 syllabus. Next, at times you are also expected to assist in the preparation of financial statements and answer queries regarding financial reporting. So very clear requirement. Again, you need to know your F1 syllabus, your IFRSs, your tax compliances, your financial statements. Knowledge will be needed, will be brought upon, and will be requested from you in case study scenarios. What are the specific topics and concepts? We are going to come to them. But this first page where they are discussing your role clearly tells you that if you do not start with good E, P and F background knowledge, please do not expect to do well on this exam, especially in the OCS, because it is technical heavy. Okay, next section, company background. So they already told you that you are the finance officer at SoPa. But what is SoPa? So SoPa is a company that operates a chain of restaurants in the country of Zealand, which is in Europe. So what you will see throughout my pre-scene is we'll take up paragraph by paragraph, highlight and underline the important words for you. And then these boxes that you see, they are my analysis. They are my linkages to E1, P1 and F1 for you. They are my linkages to the core areas for you. If you've done my introduction video, you'll already know that the OCS exam is going to test you on 6 core areas, A to F, and then each of these 6 core areas have different I can statements. Each I can statement relates to specific topics within the syllabus. So what we have done is we've pointed out the core area for you and we've pointed out the relevant topic for you. So you know that, okay, it's part of the blueprints, plus you know the topic, so it becomes very easy for you to go back and revise it. So, okay, we operate a chain of restaurants in the country of Zealand, which is in Europe. If you've done my extra industry analysis, you'll already be one step ahead, because you'll know what the opportunities, strengths, opportunities, threats are for chain-oriented restaurants. We've already covered all of that in my quick industry analysis. If you haven't watched it, please watch it. It's going to be invaluable for you. So this is in Europe. The company was founded 10 years ago in 2016 by husband and wife Paolo and Sofia. The restaurants serve food which is inspired by Latin American street food, elevated to restaurant standard. So street food elevated to restaurant standard. The currency of Zealand is the Z or Z dollars. So let's make some analysis now. So if you see, the name SoPa comes from the names of the founders, Sofia and Paolo. The name itself tells us the founder's story. So remember, we have a chain of restaurants, multiple locations, not just one. This immediately tells us costs will be spread across sites. Different restaurants will have different costs. So cost containment, cost understanding, and hence different costing methods become very important. This is part of your core area A. Costing methods, specifically absorption costing, activity based costing, marginal costing. These will be covered deeper into the pre-scene as well, but when we find something relevant, we'll put it out there for you. So your list should be number 1, costing methods, ABC, absorption costing, marginal costing. That's how you keep making your list. So okay, it's a 10-year-old business. Now it's not, I would say, in its starting phase. It's been in the market for 10 years. We will have historical data available. We will have that goodwill built over 10 years. Now, because we have historical data, it will be easier for us to forecast. We've been in the market for 10 years. So your time series analysis, forecasting methods work better because you will have historical data. So number 2 in your list, time series analysis. Number 3, different forecasting methods. Again, the specifics of which forecasting method can be used where, we will discuss deeper into the pre-scene. But as and when information comes up, let's keep making my list. Even if the topics overlap, it's fine. I'm making my own list for my own study. Next, husband and wife founders. So this is an owner managed business, which likely will have a centralized structure where one person is making all the decision. That's how it is in any business family run business. Specifically, if you look at it deeper into the pre-scene, we'll be discussing the organization layout in much more detail. But right now, it looks like, and it, for any family business, it's an owner managed business, so it will likely have a centralized structure. So from your E1 syllabus comes your centralized versus decentralized discussion. Corporate governance from your F1 also becomes important over here because there is lack of independent oversight. One person is going to be making all the decision. It's family run. There is succession planning risk. There's a nepotism risk. They might favor their own family to lead in their place once they retire, which might not be for the good of the business. It always happens, right? So by knowing that husband and wife are at the top, they're running the business, we know that it's going to be a centralized structure and there can be corporate governance issues. Both of these are topics in your E1 and F1 syllabus respectively. Now there is elevated street food. So street food, but elevated. So premium positioning. It's not going to be extremely expensive because they have not said fine dine. They've just said street food elevated to restaurant standard. It's not going to be cheap. It's not going to be fine dine. You're pretty much sitting in the middle, but still it's premium positioning. So this will affect your pricing. So P1 core area E, short-term decision making, your different pricing strategies become important discussions over here. So you see, just from this paragraph, we make so many revelations, we make so many things that you can think of. And, naturally, you would just read it as information and move on. But when you're doing an in-depth pre-scene analysis with us, you'll see a lot of linkages are made to important topics where you are making your important topic list so that you can go back and revise these topics. So now you've understood the company, plus you have revised important topics. And then when you write mock questions on them with us, and then we discuss them in our twice a week live lessons, you're so much focused on the requirement and the prep for this exam that it's bound to lead you to success. Next, both Paolo and Sofia were born and raised in Latin America, but came to work in the capital city of Zealand, Tombor, in the early 2000s. Again, these are all fictional situations that they're creating. It's a fictional country, fictional currency, fictional capital city. In 2000s is when they came to this Tombor city, which is the capital of Zealand. They met in Zealand in 2006 and married in 2012. Paolo is a chef. Very important revelation. Obviously, if you're running a restaurant, you want somebody who knows food. So Paulo is a chef. He started his training in Latin America but came to Zealand when he was 23 to further develop his skills by working in some of country's best known restaurants. Sophia came to Zealand at the age of 21. She initially worked as a server but soon worked her way up to manage front of house in two popular restaurants. So both have this restaurant background, this restaurant, just this restaurant experience with them, and then they've chosen to start SoPa. So obviously they are bringing their culture, they are bringing their experience, both of which is going to help us differentiate. So P1, differentiation, competitive advantage. What is your competitive advantage as SoPa? You have two people running the business who have background and who have cultural knowledge as well, because they come from Latin America, which helps you elevate your food better. So Paulo will know the operations, the kitchen side of the business. Sophia will know the customer facing and management side of a business. So essentially, both of these people will be able to use their skills to push the business forward. Now, all of this becomes very important for you. Now, students will tell me, okay, this is great information. You made some good links, solid. But then, yes, it's very important to make important topic list, which you're doing second. Second, it's also important to make sure that you just remember this stuff. And by remember, I mean, don't mug it up. But I'm just trying to tell you, go through the pre-scene so many times, 2 times, 3 times, 5 times, 7 times, so that these informations automatically stick into your mind. It should be like your favorite book, your favorite movie. You automatically remember the dialogues, you automatically know the characters. Same way, you should be that comfortable with the pre-scene, because trust me, that is what is going to give you an edge when you write mock questions, and edge in the exam as well. Because if you don't know your company, even if you know the concepts, what will you suggest? How will you suggest if you don't know what SoPa's workings are? If you don't know what SoPa's culture is? So all of this is very important, which you can try to remember in your own words. But it will come to you naturally if you go through this material 2 times, 3 times, 4 times, at your own pace. That is why we'll give you the video, plus we'll give you a PDF as well, which you can print out and then read at your own pace, so that you can get more accustomed to this information. So when you're thinking SoPa, directly these information should come to your mind. Okay, Sophia and Paulo working together. They came to Zealand. One is a chef, one is a front house manager with their experience. All of these things should naturally come to your mind. And it will come to your mind, trust me, not by learning, by going through it 2 times, 3 times, 4 times, as many times as possible. Because this is going to give you an edge in the exam. Moving on, throughout the early 2010s, Paulo and Sophia continued to work full-time in different restaurants, but were starting to develop a vision for their own company. So they are both passionate about the cuisine of their native Latin America and wanted to bring the flavors and culinary experience of their home countries to Zealand. So okay, they kept working, they kept having that experience plus that vision, which they used to bring native Latin American street food and elevate it to the restaurant level. They named the restaurant SoPa, a combination of Sophia and Paulo. In 2016, the company was founded and the first restaurant opened in Tombor. The restaurant was a huge success. This can be attributed to the hard work of both Paulo and Sophia in creating a dining experience that embodied high quality in a modern and relaxed setting at an affordable price. So see, you're not the fine dine, you're not cheap, you're in the middle somewhere, but still focusing on high quality, modern, relaxed setting. Let's do some analysis. So working full-time elsewhere while planning SoPa. So no outside investors initially. So sources of short-term finance and long-term finance becomes very important over here, which we'll discuss later on as well, because both came together and started the company. So there will be a limit on the finance, there will be a limit on the working capital situation, which we'll discuss later on as well when we go to the financial side. But this just came to my mind, so I put it up over here. So our brand differentiation, you need to remember that it's passion driven, the culture of Latin America, the focus and the hard work of both the founders is coming together. That's my differentiation. That's my competitive advantage. So there are 3 clear value drivers. Remember this, because this value is what you'll carry as knowledge about your company. We focus on quality, we focus on experience, and we focus on affordability. This is our value proposition. And this continuously relates to your costing methods, because you want to make sure it's affordable while you protect quality. So your costing will have to be solid so that your pricing is solid. Same way, your pricing decisions, your minimum pricing decisions from core area E, P1, become very important over here. So we are giving you the topics which are important and we are linking them back to the core areas as well for you. The second restaurant was opened in 2018, and by 2023 there were another 4 restaurants in Tombor. So first restaurant 2016, second restaurant 2018, and by 2023 there were 4 another restaurants. In 2023, Paolo and Sofia decided to expand beyond the capital city and have since opened 3 restaurants in other major Zealand cities, and there are currently 9 restaurants operating. So right now there are 9 restaurants operating. Majority of them are in, or rather 6 of them are in Tombor, 3 are in other major cities, but everything in Zealand only. So rapid expansion from 1 to 9 restaurants in 9 years. And remember, each new restaurant is a cost center. It increases the complexity of tracking your costs. It increases the complexity of delivering quality, experience, affordability, which are your value drivers. So your costing methods become even more of a focus across multiple locations. Now, expansion beyond Tombor is your geographical diversification, but also increases risk, right? So your budgeting, your forecasting becomes more complex, because now you don't only have to look at data from Tombor, you have to look at different cities as well, and different cities have different styles. People consume products or consume experiences in different ways. So different budgeting techniques are to be considered, because sometimes in the exam they'll ask you, okay, costing system has changed, so we are now looking to let's say start a ZBB approach for this particular restaurant or this particular department. How would we go about making it work? So the concept of different budgeting techniques will have to be clear. Again, when you do your revision, you see over here they're not asking you, or they will never ask you to remember any definitions, nothing like that. How does ZBB work? Maybe. So this is how you should revise. Okay, when you're doing the ZBB revision, okay, can I explain how ZBB works? It means starting from 0. It means having different work packages, define the costs from the very beginning. Excess wastages are removed. Can I just make sure I explain ZBB in my own words? If you're able to do that, you're already meeting the requirement of this exam. Couple advantages, couple disadvantages, tick mark, move on. So details are not the need for this exam. The need for this exam is to be able to explain the concept in your own words, in simple, easy theory. Let's move on. In the last financial year to 31st December, the company had a revenue of 41.7 million. It's not a small company, huge numbers. A gross profit margin of 32.6%, operating profit margin of 9.4%. 300 people are employed, and the company is still 100% owned by Paolo and Sofia. So the revenue is 41.7. It's a significant sized business. Gross profit margin is 32.6. So cost of sales is consuming 67.4% of the revenue. Naturally, your food costs, your beverage costs, or what you are buying in is going to be high because you're focusing on quality. So this is consuming 67.4%. Operating profit margin is 9.4%. So after your operating expenses from this 32.6, you'll remove percentage, which is you will remove your operating expenses. The margin drops significantly, suggesting high overheads burden. From 32.6, your profit only is 9.4. So the gap between the GPM and the OPM, gross profit and operating profit, is 22.2%. So your staff, your rent, your utilities across 9 sites, your electricity, your all other overheads, marketing cost, and all other overheads are a significant percentage. Now this becomes a very important piece of data, because when you have different overheads, which we'll see later on as well in section 3 when we do the financial analysis, when we have different sets of overheads, it's always best to have a modern costing system like activity based costing. So the need for activity based costing is very evident over here, which we'll speak about later on as well, because this is an exam favorite topic. So I want to speak about it later on when we in the financial analysis segment, when we are doing the budgeting analysis. But it's very clear over here, right? Also, KPIs and margin analysis becomes important over here to make sure that we keep hitting or we keep focus on quality, we keep focus on experience, we keep focus on cost control. So these KPIs will become important, and KPIs are being hugely tested in the OCS. So key performance indicators to keep improving on my 3 major value propositions: quality, affordability, experience. These 3 become very important. Now we have a large workforce across multiple sites, so there is going to be significant labor cost and HR management challenges. 300 people are employed. So labor is a key concept for me, is a key cost for me. So everything revolving around labor, for example, your idle time variances, your labor variances, your labor management, which goes into the HR aspect, all of this will be very important for us. Next, for future funding for further expansion may require bringing outside investors, because still Paolo and Sofia own 100% of the business. If you want to expand more, you might need more finance. So might have to have new investors, sell part of the company, sources of finance concept from your F1 becomes important over here. So you see, just from this one paragraph, so many important revelations can be made. But you need to be aware of this. You need to be made aware of this, which is what we are doing through this detailed pre-scene analysis for you. Next segment is restaurant industry. So first segment we spoke about was your role. Then we spoke about the introduction of SoPa, how SoPa, came about, how it started. Now we are going to restaurant industry, which means they're giving us a little bit of a background of what the restaurant industry is like in Zealand, so that you can make sense of the position SoPa is in. But guess what? If you've already done my industry analysis, a lot of these ideas are already there in your mind. A lot of the trends are already there in your mind. So you can make sense of this entire pre-scene from the first page in a much better way, I feel. So the restaurant industry in Zealand is highly competitive, especially in the capital city where there is a large and diverse restaurant scene. So where we are in Tombor, where we have majority of our restaurants, 6 restaurants, that's where it's highly competitive and there is a large and diverse restaurant scene. For the year 31st December 2025, restaurant revenue in Zealand was 45 billion. So firstly, they're telling us it's a highly competitive market. So we need to make sure that we continuously defend our position. So what are my competitive strengths? What is my market positioning? Being very aware of this, and then using different techniques like we learned in the industry analysis. What are we doing in terms of technology, AI integration? What are we doing in terms of marketing, different marketing techniques? What are we doing in terms of bettering my strengths? All of this becomes very important because it's a highly competitive market. And this is part of your E1, P1 and F1 syllabus as well, right? Different marketing techniques, how you use AI, Gen AI specifically. Because this has also been introduced newly in the May 2026 syllabus, it becomes very important for companies like us to use this, new innovative techniques to make sure we are able to defend our position because it's a highly competitive market. So, diverse restaurant scene in Tombor, lots of choice for customers, making differentiation critical. If you are not different, nobody's coming to you. So you will need strong KPIs to monitor your performance and to make sure you are different. Now, SoPa's revenue was 41.7 million given to us in the previous page. The industry is at 45 billion. So you are a very small player within this industry, which is very clear and evident for us over here, because you have pretty much 0.09% of the market. You're a very small player in this huge market. So there is significant room to grow, but also dominated by larger players like fast food chains or big chains, which we have spoken about in the industry analysis as well. Many companies in the industry own and operate multiple restaurants, although some companies do operate single restaurants as well. We already know the structure of this market. There can be chains, there can be individual restaurants, there can be smaller chains, specific chains like SoPa. So corporate failure is common in the Zealand restaurant industry, and reasons include poor reviews, expanding too fast, too much diversity in terms of the food and the dining experience, leading to confused branding. Now, SoPa in itself has already dealt with two of these specifically, I can say. Because we have been in the market for 10 years, because we are very specifically focused on Latin American street food and elevating it, customer reviews have been positive, and there is not too much diversity, so there is no confusion in the brand image. But expanding too fast, I don't feel that it has been too fast for SoPa, but it's still been rapid. In 9 to 10 years, you have gone to 10 restaurants. So you are moving fast, which very clearly raises working capital issues. And working capital has become very important, or rather even more important than before, as an OCS exam question. Like, how will you manage payables, how many manage receivables, short-term finance, working capital cycle management has become very important, and that is why it should be an important revision topic for you as well. So SoPa with 9 restaurants sits in the middle ground, not as a single operator, not a large chain. There is a high failure rate, which means this is a high risk industry. So there will have to be a lot of risk and uncertainty planning within your short-term decision making. So the use of forecasting techniques, the use of payoff tables, the use of maybe time series analysis, the use of linear programming problems, LPPs, to help you decide the optimum let's say just the optimum level of the optimum level at which your organization should run, the optimum level of purchasing, the optimum level of finance to be held by your company. All of this becomes very important. So your risk and uncertainty chapter from P1, which is part of your core area E, becomes very, very important. Food quality and service, this is my core value, is directly threatened here if we do not have strong financial as well as non-financial KPIs. See, up until now I was speaking only about financial KPIs. Non-financial KPIs become even more important, like customer satisfaction, customer reviews. So SoPa has grown from 1 to 9 restaurants in 9 years. So your working capital that I spoke about, part is being dealt with over here. Growth in the restaurant industry over the past 3 years has been relatively stagnant at an average of only 3% per year, largely as a result of the following key challenges. So market is huge. We are only 0.09% of the market. There is great space for growth, but the market itself is growing at 3% only. Why? Because of economic factors. So low consumer confidence brought about by high interest rates and cost of living is increasing, so people are spending less on food. Second, cost pressures. Cost pressures from food inflation, increases in both property costs and national minimum wage is cutting the margins of restaurants. High staff turnover is a problem. Difficulty in recruitment attributed to low wages, long hours, and poor working conditions. The labor force is mainly young and transient. Many workers are just considering it as a part-time job. So these industry challenges also contribute toward corporate failure within the industry. So corporate failure, 3 reasons were given to us: growing too fast, poor reviews, and too much diversity. Another 3 factors can be added: economic factors, cost pressures, and high staff turnover. All of these are issues because of which companies are failing. So what is SoPa doing to stay away from these? What is SoPa doing to be different from these? That's what we'll try to figure throughout the pre-scene. Already we know we are focusing on good quality, good customer experience, good dining experience. We're already focusing on this. But what are we doing for controlling our costs? What are we doing for making our staff happy? That's what we'll try to figure out deeper into the pre-scene again. So SoPa's own growth must be viewed against the industry standard. When we go to our financial analysis section, part 3, we will see if our growth is better than 3%. If it's better than 3%, which is the market growth rate, which means we are still in let's say a growth phase, and there is still opportunity out there for us. Now, 3 simultaneous cost pressures hitting SoPa's cost of sales and overheads. Remember, already we incur a huge amount of overheads. That is why our operating profit margin was around 9%. Because food costs are going up, property costs are going up, minimum wage costs are going up. All of this is affecting my costs. So cost management becomes even more important. Budgeting becomes even more important. Different costing techniques, different budgeting techniques. Variance analysis becomes even more important. These will generate adverse material price variances, adverse labor rate variances. How do we look at these? How do we plan for these? So knowing all of your different variances become very, very important. Material, labor, idle time, fixed overhead, sales variances. These are very important for the OCS because they are often tested. And very clearly only they've given us a hint that all of these costs are increasing. If these costs are increasing, my cost management, has an effect. My variances has an effect. Okay, high turnover, which means increased recruitment and training costs, also risks inconsistent service qualities. So labor as a cost component becomes very, very important for us. Motivating my staff, making sure we reward them properly, making sure clear KPIs are set for my staff become very important to reduce this turnover and to reduce idle time as well. Next, for 2026 and beyond, the growth in the industry is expected to increase to around 4.5%. So okay, growth from 3% is going to 4.5%. So improving outlook, SoPa should be planning for higher demand. So time series analysis and forecasting to capture this upward trend. If my restaurants are continuously going full and I don't forecast better that okay, this is the right time to open a restaurant, this is the right time to buy more ingredients so that I don't sell out. All of this affects a restaurant's profit. So how are we using time series analysis to better make decisions? How are we using forecasting techniques to better make decisions? This is part of your core area B. Time series analysis as a topic, forecasting techniques as a topic. Whilst the key challenges noted above still exist, the following are key opportunities for survival and growth. So they gave us challenges. Now they're giving us opportunities. Remember, we already know this from our industry analysis. We are already carrying that knowledge from our industry analysis. The first is embrace technology. So harnessing the power of AI for everything from menu development to inventory management. We already spoke about technology as a major growth factor for our business. This is being very clearly pointed out for you within the pre-scene. So how are we embracing technology? How are we using AI? How are we using robotics in kitchens and front of house? So AI in menu development is equal to data-driven decisions on which dishes to keep, which to remove, which to introduce. AI in inventory management helps with smarter stock control, reducing waste. This is clearly linking to inventory management systems like your JIT system, like your EOQ, economic order quantity. AI helps you with how much to order, when to order, where to order from. So JIT, EOQ from your F, core area F, become important. AI and Gen AI, new syllabus area updates, become very important for this business. How are we using Gen AI to make better decisions? On the other hand, robotics has been mentioned. Now, having robots, yes, it's technologically advanced, but this will be a capital investment decision with long-term implications. So this can directly address your high staff turnover problem. If you have robots, staff turnover is not an issue for you anymore. But buying these robots become an asset for your business, becomes your asset which needs to be managed under IAS 16. It's your equipment. So property, plant and equipment gets tested over here. Robotics would be capitalized as a non-current asset. What is the depreciation, the revaluation, the selling of the assets held for sale, the selling of all of this follows your F1 syllabus IAS 16. There's a chance of how it may be tested. So a lot of decisions or a lot of direction given to you over here just because they have mentioned that okay, technology is going to be a growth factor. So definitely expect something, some situation around technology in the exam. Next, focus on guest experience, creating an unforgettable dining experience, whether that be catering to dietary requirements or creating an immersive experience. We are already focusing on this. So this is already aligned to my value proposition of being quality, modern, relaxed setting. But it further tells us that the guest experience non-financial KPI becomes very, very important. And this directly links to my 4 P's of marketing: product, price, place, promotion. How I'm putting my product forward, the people involved, the promotion involved, the price involved. So the marketing mix becomes very important. Next, dynamic pricing, providing time-sensitive discounts or off-peak meal deals to increase the number of covers and increase occupancy rates. So this is what you'll see in many restaurants around you as well. Maybe they'll have a happy hour or they'll have something off on snacks, anything. So dynamic pricing is deliberately varying the price. This directly relates rather to your pricing strategies, your price discrimination, dynamic pricing, pricing decisions, and very importantly, relevant costs. Because when you change the price of your products, what is relevant, what is not relevant becomes a very important decision so that you know what dynamic price to set. You obviously want to consider all relevant costs and then set a dynamic price because you don't want to make an overall loss for your business. So the relevant costing principles, core area E, come into the situation over here. Next, invest in people. Investing in the workforce by providing fair wages and good working conditions. So again, this directly encounters the high staff turnover problem. How we deal with staff, everything related to staff is very important for this industry. Last, diversification. So diversifying into takeaway and home delivery services where growth continues to outpace dining out. We already know from our industry analysis that takeaway and home delivery service are the fastest growing segments within this industry. So this is a new revenue stream, but also strategic shift. A lot of businesses are moving to, let's say, setting up a cloud kitchen or setting up a brand, separate brand, which only deals with deliveries, which only deals with delivery platforms, because this is where the growth is. So also the decision over here is make or buy, because over here, should I have my own delivery or should I use third-party platforms? That decision will come up. So your make or buy decision, your relevant costing decision, your outsourcing or not outsourcing decision comes into the picture over here, because delivery is in the growth phase. This is related to your P1 syllabus core area E. You see, these topics will not even come to your mind if you have not in depth studied the syllabus areas, or rather, like us, if you don't have somebody giving you this guidance, these topics will not come to your mind. So you see, you're understanding the company. In these first pages itself, you've understood the company so well. Plus, you now have a list of solid important topics which you are going to go back and revise, that adds so much value to your prep. Next section they've given us is called extracts from the SoPa website. So they're just trying to tell you more about the company by giving you an extract from the website. So up until now we were speaking about the restaurant industry. Now we are going to about SoPa, which has been listed on SoPa's website. Again, this is all fictional. So we are looking at the About Us page on the website. First, we'll start with our story. We already know the story. We are a husband and wife team from Latin America, but we are putting it out there for the customer. So now being true to my, let's say, culture becomes very important. True to my background becomes very important, because we are putting it out there and we are marketing on it. So we are a husband and wife team from Latin America, united by a passion for sharing the rich culinary heritage of our homeland. Over the years, we have had the privilege of working in kitchens in Latin America and Zealand. Each experience shaped our vision and what dining can be. So this is a passion-driven story. It's very clear. Strong brand identity and authenticity. This is SoPa's core differentiator in a crowded market. Sorry, just zooming in a little bit for you. Yes. Now, diverse experience across 2 continents. So it's deep knowledge. So Paolo in the kitchen, Sofia in the front house, combined expertise covering the entire value chain. So the entire value that is delivered to the customer is being covered because of the experience of our founders. Next, our home. After a journey filled with flavors, friendships, and faraway places, we found ourselves in Zealand, a place we now gratefully call home. It is here, surrounded by nature and community, that we've planted the roots of our restaurants and built a space that celebrates tradition whilst embracing change. So emotional narrative is being put up. This is what we are putting forward as our marketing strategy, that okay, all of our knowledge from our Latin America heritage is being brought to our kitchens. Next, our food. Our food is grounded in the recipes we grew up with, but elevated with contemporary techniques. Fresh local ingredients and a deep respect for sustainability. We believe in moving our beloved cuisine into the future, refining it, reimagining it. So first, very important hint over here is fresh local ingredients. which means you have a supply chain dependency on local suppliers. Supply chain management, supplier relationships, quality control becomes critical from your E1 syllabus. Next hint is sustainability. This directly links to your again new syllabus area, environmental costing. Sustainability adds costs that need tracking. So how are we tracking our environmental prevention costs, our environmental appraisal costs, environmental internal failure, external failure costs? This becomes a very important consideration because sustainability is embedded within the culture of my organization. Now we have shown a continuous improvement mindset, which means because we have had ongoing product development costs. Again, this brings your quality costing framework into the situation. Cost of improvement versus the cost of failure is considered over here because you are a forward-looking company. A lot of hints in this small paragraph itself and a lot of topics very prevalent because of this small paragraph. Next, we have our locations. So we have SoPa, Tombor. Again, it's very clear that 6 restaurants are within Tombor and 3 restaurants are outside of Tombor into the cities of Cache, Salt and Meltan. So this is organizational structure little bit for us to look at because it's geographically spread now. But one very important topic coming to my mind is when you have different restaurants. Naturally in the restaurant market, you will not buy spaces, right? You will lease out these spaces. So when you are leasing out spaces in IFRS 16, leases becomes a very important topic over here. You might be leasing out the space or you might be leasing out kitchen equipment, anything, anything can be thought of as a lease being created, and in the exam this is often tested, especially for spaces that on which your restaurant is going to be situated. So you leased out a shop which you are going to convert into a restaurant. So leasing, how the lease will be recorded, the right of use of asset, the lease liability, what will be the effects on the financial statements. These are often questions which are asked. So IFRS 16 revision, very important. A very clear hint also given to you within the pre-scene, so we cannot ignore it. Next is our team. Now behind every dish is a team we cherish. Our restaurants are built not just on a passion for food, but on a love for people. We invest in our employees. Again, very clearly linking it back to the high staff turnover problem. Staff turnover is very well noted within this industry, and we are taking care of that by investing in my team. Our future. Our restaurant reflects who we are, rooted in heritage, shaped by experience, powered by innovation. We can't wait to welcome you. So very clearly it is linking back to my core value propositions. My experience, my innovation, high quality, investing in staff, having a great dining experience. All of this is very clear and again reinforced through this section. Now to make it a little bit more realistic, they gave us restaurant menu. I will just quickly have an overview of this restaurant menu for you. You'll see that very clearly the drinks start from $3. I'll just zoom in just to make it a more clear for you. Drinks start from $3 to $15. They have alcoholic as well as non-alcoholic. And hot drinks start from $4. So you'll see it's not extensively, remember we are in Europe. So this can be somewhat compared to European prices, not direct, but you'll see that this is somewhat within the not very expensive range, in the middle segment. We have starters which go from $9 to $13. The mains go from $16 to $21, or rather $25, sorry. And the desserts are pretty much $8 each. The sides are $2 and $3. So now what do I take away from this? This menu has been given to very much show how we position ourselves. So this is the affordable pricing consistent with my value proposition, which we already dealt with. Now the price range is narrow and modest. Your pricing decisions, your minimum pricing, your contribution analysis becomes important over here as a consideration, because next time when you are setting a price, you will have to be within this bandwidth. You have to control your costs better to make sure you are maintaining this price band. Now salads and specials, these are seasonal dishes which change weekly. Now if weekly they change, they've told us to us in the menu, means you need variable ingredients, so it's harder to standardize. The ingredients keep changing, so how will you standardize the cost? A standard cost card cannot be created. So this is a very clear direction that traditional costing methods for this business will be very, very difficult, because ingredients keep changing. Guess, for example, let's say you're making pencils, just as an example. Every time wood is only going to be used. So, and wood prices drastically will not change overnight, right? Unless there is something major in the world which we are any which ways not considering. But over here, your dish is completely changing. If the dish changes, yesterday you needed lettuce. Today you don't need lettuce and you probably need a more expensive ingredient. So standard costing becomes even more difficult. So standard costing systems will not work for this business. Variance analysis also becomes complex. Now your special, which is your seasonal dish which changes. So this is a high priced special in mains, dynamic pricing opportunity. Weekly changes require agile supply chain management. If you don't have good inventory management, none of this will be possible. So your inventory, let's say your inventory management techniques, EOQ, material requirement planning, your AI based ordering, like we spoke about, JIT, your IAS 2, how we financially record inventories. All of this, everything related to inventories becomes very important over here. So this menu, you'll see, many might think that, okay, this is just an overview of what the business is offering. But no, it has a lot of detailed insights like we just discussed. So with that, I have come to the end of part 1 of our analysis. This is only part 1, where I aim to just introduce you to the system, to how how we do our pre-scene, to introduce you to why you should make your topic list. So first I want you to be very comfortable with part 1. So go through part number 1 again if you want, read through the PDF, let it sink in slowly. After that, move to part 2 and move to part 3. If you have any questions, solve the questions on part 1 first, be comfortable with part 1 first, and only then we move on. There is no hurry. It's very important to understand our company. That's part 1. Welcome to part 2 now. In this part 2, we are carrying on from part 1 obviously, but we go into the depths of this company. We go into exactly discussing the details of this company. So you should be very sure and certain about part 1 and the industry analysis as well. So if you're not sure about the industry analysis and part 1, please first spend time on it. Please concrete your knowledge on the topics that have been highlighted up until now in part 1. Don't be like, okay, I'll just do all the topics together. My suggestion is go through the topic list which you have created, revise the topics within the topic list so that knowledge is in your mind and you will be able to better use it, apply it in part 2 as well. Because some of those theories, some of those topics I will again bring up. If you've revised them, it will add more, it will add more value to your preparation. So essentially, part 2 is starting where we left off. We, in part number 1, ended with the restaurant menu analysis. And now we are on the key management teams. We are starting with the directors. So they have given us the management teams who are running our company. It becomes very important for us to understand the people who are running the company, because these people are going to decide the future. These people are going to make the day-to-day decisions of this company. Now, before I move on, there are some very important reasons of why we are doing this pre-scene analysis, which sometimes students get wrong. So this pre-scene analysis number 1 is being done because without knowing your company, you cannot answer a case study style exam. Very simple. Without knowing SoPa, you cannot answer SoPa related questions which are going to come up in the exam. So that is why we are doing the pre-scene analysis. Number 2, we are doing this pre-scene analysis so that we can highlight important E, P and F topics. Up until now, I have given you so many important relations to E, P and F topics. We will continue doing that. If we don't do this in-depth pre-scene analysis, we don't get this important topic list, so we don't revise the important topics. So number 1 is to understand our company, number 2 is to highlight important topics, and number 3, very, very, very important, which is often overlooked, use these ideas when the time comes in your practice, in your mock questions, so that you can essentially use them in the final exam as well. For example, when you are writing something, you can say, let's say you're writing an answer which is related to the future of the company. For example, you can say, okay, let's take the opinion of, and you're talking to your finance manager. Let's take the opinion of Paulo Perez because he is an expert. He started our organization. He has in-depth knowledge about this. So we should take his view as well on this project, for example. So just giving you a simple example of how you can intertwine your knowledge about the pre-scene within your answers. But how will this come to you? Only if you have spent time on the pre-scene. So I always say go through the pre-scene multiple times before your exam. Yes, you have limited time. Go through the videos 2 times. All the pre-scene videos, go through them 2 times. But the PDF, this PDF that you're seeing on screen, which we have given access to you, you should be reading it at least, I will say 7-8 times before the date of your exam. And it's going to be, trust me, the first couple of times it will be like new stuff. From the 3rd, 4th time, you'll know where is what. And every time you read the pre-scene, new things will come to your mind. But you'll have to spend that time. You'll have to understand that the pre-scene is very, very, very important. So these 3 reasons are why we give so much time to the pre-scene and why you should be giving time to the pre-scene, because it is pretty much the backbone of your exam. Let's start. Who are the directors? We have Paulo Perez at the top. So Paulo Perez at the top, and then under him there are our different directors handling different departments. From the very onset, this is looking like a functional structure. One person at the top, everybody below him, everybody reporting to him, and he is taking the final decisions. So it's looking like a functional structure. Your different organizational structures are an E1 topic that you should be revising and well versed with. What are the advantages of a functional structure? Disadvantages of our current structure, which is a functional structure, should be, clear within your mind. Let's start with Paulo at the top. So I'll just read out an extract on our website which has been given. We've not included it within the pre-scene because it's just 1 or 2 lines. We directly have an analysis on it. But first we'll start with Paulo. So they say that Paulo, there's an extract on the website which describes our directors. So that extract for Paulo is that with many years of experience as a chef and my passion for the authentic cuisine of my homeland, all of which we already know. Sorry, just putting it on my screen. Yes, I love nothing more than being in the kitchen, developing new dishes to tickle your taste buds. So very clearly, they're pretty much telling us what we already know, that okay, he's bringing his culture to this country and serving people, and people have loved what is being served. So Paolo holds two roles simultaneously: strategy and leadership. Remember, he's a managing director, so day-to-day decisions, plus he's the chef. So he has to develop new recipes, plus he has to run the business. His passion lies in cooking. So the question is, yes, is he giving enough time to running the business? Because doing both things as the business grows, it's also adding new and new things. Like, deeper into the pre-scene, we learn that we want to expand new restaurants plus new ventures. Will Paolo will be able to do everything? So this is a significant governance issue. Too much concentration of power with one person, which is a centralized structure, a functional structure that we have spoken of. So the advantages of a functional structure, disadvantages of a functional structure, moving maybe to a divisional structure, matrix structure should be something that you should be aware of. This is your E1 syllabus. Next, we are moving to Sophia. So she's the restaurant operations director. With over 2 decades, I'm again first reading the extract. With over 2 decades of experience in the industry, I use my position to oversee restaurant design and training of all front of house employees. So she has experience, she oversees the design of the restaurant and front of house employees, both of which very important, because remember, we want a stable let's say experience in all of our restaurants, plus we want our employees to be trained for a good experience. So again, coming to our analysis, Sophia manages all 9 restaurants. Enormous operational span of control. If you look at the span of control, it's very large because all 9 restaurants. Responsible for restaurant design and training. As SoPa grows beyond Tombor, capital city, beyond our country also, this becomes increasingly difficult to manage. Because her span of control is so large, it becomes important to understand maybe another person might be needed to help her. So what are tall organizations, what are flat organizations, comes into the discussion over here. E1 syllabus. Remember, she is the operations director, so all operational related KPIs, whether they may be staff related, design related, anything related to operations, she might need to set proper KPIs related to operations so that she can judge if the business is actually running like she wants it to run. Next, we have Tobias Smith, marketing director. I'm reading the extract first. So I am delighted to be using my 30 years of experience, which has been spent driving marketing for some of the largest restaurant chains to support our amazing brand, to develop nationally and internationally. Hint given to you very clearly over here, there is going to be an expansion scenario coming up. So he has 30 years of experience, which is to a great competitive advantage for us. Whenever you're talking about marketing, try to plug in his name. That okay, let's take the overview, let's take the opinion of Tobias, because he's been in the market for 30 years. His experience with large chains is also very, very valuable for us. So how, Tobias will be using digital marketing, AI marketing, promotional strategies, different different market segmentations will be very, very important, and this falls within your E1 remit, because this is now the major trend. How well you market, how well you show your company is very, very important. Next, we have Lu Chen, who is the human resources director, a very important role for my company because we rely so much on the people who provide the service. Extracts. So having worked in many countries and organizations in the hotel and restaurant industry, I pride myself on developing a positive workplace culture, leading talent acquisition, supporting professional growth. So she has also been in the market. She also has the relative experience. So you can see that the directors that we have put in place have the right experience, have the right background, which can push the company forward. So worked across multiple countries and organizations in hospitality, focuses on diversity, talent acquisition, and professional growth. A dedicated HR director is very, very important because we in our business have high staff turnover, which is an industry challenge spoken about in the industry analysis and earlier in the pre-scene as well. This brings in your HR topics from E1. So HR related KPIs, the HR recruitment cycle, motivation of employees, everything related to employee well-being will directly be led by Lu Chen. Next, we have Raj Patel, Finance Director. So as my first move from accounting practice to industry, I'm reading the extract. It has been very gratifying to use my existing knowledge and experience of supporting clients in the restaurant industry to support SoPa at this exciting time of growth and development. So again, first move from accounting practice to industry. So brings external client side experience. He has that again experience with him. He understands sector specific financial challenges. He's worked in the restaurant industry. So now very important for us to remember that Raj is going to be our boss. Finance director, finance manager, and under that you are coming. So overall, if you look at the structure of the organization over here, you'll see it's pretty flat. There's one person at the top and then there are 4 people reporting to that one person. So only one layer between Paolo and the functional directors, appropriate for our current size. But we will need to evolve as SoPa expands nationally and internationally. One, because this is not very tested at the OCS level, but because it's over here, they've given us the structure. There's a governance gap a little bit because there are no non-executive directors. This is generally needed for large listed companies. We are not a listed company, fully privately owned, but having non-executive directors can be a way of bringing outside experience in places where our board of directors do not have that experience. And essentially, it's just something which is part of our governance topic from F1. So I just thought I'll bring it in. It's not heavily tested, but just something for us to keep in mind. But majorly, you should be remembering what each director is good at. What are their core strengths? What each director is responsible for, so that you can plug it into your answers. And if a question says that, okay, this person is looking at this, then you can directly understand that, okay, this is within his remit, this is this person's background, things will make sense to you. That's the advantage of doing this, essentially director analysis. Okay, this was the directors. We have other teams as well, starting with the finance team. Now we already know that Raj is going to be our boss. Under him comes Jack. And under that is you, 3 finance officers. So Raj is the finance director, top of the finance hierarchy. Jack sits between the finance director and the operational team. He will be managing budgets, financial controls, key contact for our work as finance officers. So essentially your exam scenarios will pretty much be with Jack, because you are assisting Jack, Jack is assisting Raj. So 3 finance officers, out of which you are part of that. Your role will be majorly bridging data and analysis. They might give you the data, you might have to do the analysis. They might have, they'll give you, okay, this has happened, what does this mean? So variances, responding to queries, that's where your major role is, which we have already spoken about at the very, very beginning. So here you can see the structure being the difference between a flat structure and a tall structure. Here it's tall because one by one there are responsibilities. So clear reporting lines, there is a director, there is a head, there is officers, and then there are assistants as well. But at the end of the day, there is still centralized control. Raj is the boss. Raj then reports to Paolo, and then Paolo takes the final decision. Next, we have the restaurant operations team. Obviously, Sophia is going to be the head over here because she is the operations director. Under her, she has a big span of control. Remember that, because she looks at everything related to operations. So she is going to be reported to by Ben, who is the head of the kitchen, Georgie, who is the head of the front house, and Tim, who is the head of property and equipment. So the restaurant operations team has ultimate responsibility for operations of all the company's restaurants and is based at the head office. So it's centralized at the head office and it's ultimate responsibility of all aspects. So Sophia at the top oversees the the entire operations for our 9 restaurants. Ben is the head of kitchen. So responsible for kitchen operations. What is kitchen operations? Essentially the food quality, the consistency of the kitchen staffing. Ben will be an important link of Paolo's vision, because remember, Paolo is the executive director and the executive chef also. So the chef will have to be linked to the head of the kitchen. You can see how roles are intertwining. The chef will have to be linked to the head of the kitchen so that their vision is aligned. So he's a key link to Paolo's vision as executive chef. So he translates Paolo's food standards into daily operations. So your quality management comes into the picture over here. Your kitchen related KPIs, like for example food waste, cost per dish, quality scores, quality consistency, all KPIs related to the kitchen get handled by Ben, which essentially is the responsibility of Sophia. Next, we have Georgie, head of front house. So manages the customer facing operations, service standards, customer experience. This directly impacts our customer reviews and reputations. So over here, your non-financial KPIs coming into the picture. Last, we have Tim Jones, head of property and equipment. Manages physical assets across all 9 sites. A very important role because you will have lots of movable, immovable property. So your IFRS 16 leases, your IS 16 property, plant and equipment come into the picture over here, because property costs are significant, requiring careful management. So how are we leasing kitchen equipment, for example? How are we leasing the restaurant sites? Or let's say, are we buying out kitchen equipment? So IFRS 16, how do you record leases? IS 16, how do you record the purchase of a new asset? The depreciation, the revaluation, all of that becomes a very realistic exam scenario because of the nature of our business. Okay, now this is a central team. Remember that. This central team sits at the central office. There is no site level managers visible as of now. So this raises the question of how individual restaurants are supervised day to day. Now Georgie or anybody is not going to go day to day and check, right? So the site level management could be something where digitization can be considered. So day to day, if you receive data from your 9 sites or from your 8 sites, whatever is running currently, you can decide if the current rules which are being set or the current standards which are being set at the head office are realistic. Are they being followed? So that's a digitization idea. I'll speak more about digital costing later on because I have an example for that, or a very direct hint from the pre-scene on that later on, but just got the idea right now, so I discussed it for you. Now each individual restaurant also has the following structure. There's a restaurant manager at the top, and then there is head chef, front of house manager. The head chef has a sous chef. The front of house manager has a bar manager and a server manager. So this is the structure for each restaurant. So each of the 9 restaurants has its own restaurant manager. So that's where your day-to-day operational accountability lies. Georgie has a problem. She will directly call the restaurant manager. Okay, at your restaurant, this is not good, for example. Or these KPIs are not being followed. So the question that I raised earlier about who is responsible for the day-to-day, That's the restaurant manager. And maybe we can have a digital tool to help the centralized senior managers make better decisions. So this acts as a bridge between head office and the individual restaurant. So restaurant manager is the responsibility center manager. He is held responsible. Whatever happens in his restaurant, he is responsible. So the responsibility accounting principle coming into the picture over here. Under him, there is a head chef and then there is a sous chef. So 2-level kitchen hierarchy ensures that Paolo, then Ben, food standards are consistent. Every time food standards comes up, quality management is something that you should be thinking about. Front of house manager has a bar manager, has a server manager. These are very important revenue streams. So separate KPIs for bar and floor performance could be important so that we can improve our bar revenue. Because these are important, just if you visit a restaurant, you'll always see that the drinks prices are a little bit high. They're high because those are the high margin items. We're going to learn about this deeper into the financial analysis. But again, found it important over here, so I mentioned it. Now, each restaurant is a mini business in itself. There's a 2-tier management structure. There's a head office structure and then there is a restaurant by itself structure as well. So this was pretty much our, if you look at it, the key management teams which we have discussed in this section. The next section is about the other information about our operations. So we started with the management teams. We're now going to other operational information. First, we'll speak about menu and product development. These are very important for us. So in his role as managing director and executive chef, Paolo Perez is responsible for the menu, which is the same for each restaurant. Standardization. He is based at the head office but uses a section of the kitchen in the first SoPa restaurant where he is developing new dishes. Because he's the executive director, he's at the top, makes all the decisions, final calls. Obviously, he is needed at the head office. But he also uses a section of the kitchen to develop new dishes. He liaises closely with ingredient suppliers to ensure that new dishes deliver the flavors of Latin America, but utilize ingredients and produce that are as far as possible sustainably sourced. Now the first introduction about our policy on sustainability is being brought about. Sustainability in itself, I'm going to speak about it. So single standardized menu across 9 restaurants, consistency, brand structure, already spoke about it. One important consideration over here is because consistency, same restaurants, same ingredients, same cost per dish on all sites. So the standard costing system and cost per dish calculation becomes much easier. So that is why later on into the pre-scene as well, we will see that the standard costing system is being used by the business. Why? Because same menu, same ingredients, same everything. So standard costing becomes easier. However, one menu for 9 sites also means no flexibility to respond to local tastes. Remember, in one country itself, majority of our restaurants are in Tombor. But in one country itself, different cities have different consumptions. Just to keep in mind. So Paolo splits his time between headquarters and the kitchen. Paolo personally manages key supplier relationships. You can see how important it is that Paolo, as the leader of the organization, does everything right. He makes the final calls. He liaises with ingredient suppliers. He is developing new dishes. So pretty much the business is reliant on him. If he steps back or anything happens to him, or if he leaves, or if he decides to sell, can the business move forward? Remember, you are working for the business. You are not working for Paolo. You are working for SoPa. A very important aspect was sustainability. So in the new May 2026 onwards syllabus changes, sustainability is a big theme, which you will also see in this pre-scene, where they've clearly mentioned that all of our ingredients we try to be as sustainably sourced as possible. So your environmental costing coming into the picture over here, because you will have to pay a sustainability premium. To source sustainable vegetables, ingredients need to pay a premium. This essentially can be used for marketing, but this cost has to be passed on to your customer. Dishes will be slightly more expensive, but you are a let's say socially responsible business. That's what they're trying to tell us. The menu always includes SoPa signature dishes, which stay on the menu for a number of months. So menu is changing. So Paolo's role becomes even more important because he has to develop new and new dishes. It also includes specials which change on a weekly basis depending on the ingredients and produce available at that time. So signature dishes, predictable, standardized cost, easier to budget. So your standard costing, variance analysis becomes more meaningful. But signature dishes themselves are not changing. The weekly changing specials are the ones where things get tricky, because they are variable and unpredictable ingredient costs. So standard costing becomes difficult to apply over here. Costs will fluctuate, costs will change. So challenges in standard costing are coming up over here. So maybe we need a new costing system for this particular, let's say, not for only one product, but essentially to make better decisions. Maybe a new costing system can be a scenario that they bring up. So your different costing systems, activity-based costing, marginal costing, absorption costing, are the ones which you should be well versed with. Now also, they've said that weekly specials depend on the ingredients which are available. So your inventory management comes into the picture over here. Your IAS2, the inventory management rules, also come into the picture over here. From a working capital situation, fresh seasonal ingredients require careful stock control. This is an opportunity for examiners to test how much to order, how to order, how much to invest in buying ingredients, inventory, because ingredients are your inventory. So chance for them to test working capital over here, because again of the nature of these weekly changing specials, which depend on the ingredients that are available. For all new dishes, Paolo creates a detailed recipe with clear instructions for the preparation and the cooking. He also videos himself preparing and cooking the dish, giving verbal instructions. So everything is detailed, because obviously he then has to pass it to Ben. Ben has to pass it to the head chef in each restaurant. So recipes and videos are sent to the head chef of each restaurant to ensure consistency. So this is an attempt to ensure consistency across all 9 sites. This is SoPa's quality control mechanism. This directly addresses the corporate failure risk. Remember, in the industry section before, they spoke about major businesses failing because of inconsistent quality. We are directly addressing this within our company by making a detailed video for each recipe, because consistency is very, very, very important. And the role of our HR director also becomes important over here, to make sure there is training, so that, and awareness, that everybody understands that following consistency, following the recipe is very important for the business's success. As well as menu development, Paolo is also working on a project to develop a range of SoPa branded dips to be sold direct to customers. A major development coming up over here. We already know our sustainability credentials, but now they are telling us that a new project altogether, SoPa branded dips, maybe a pesto dip or a mushroom dip, or any kind of dips, just giving you an example, is what our business is planning to introduce now, sold directly to customers. A small supermarket chain has already expressed an interest in stocking such products. See, remember, Up until now, people used to come to your restaurant. You would have direct access to customers. Now you are bringing these dips which you will sell to customers directly, but there is also the chance that you will have to deal with a retailing intermediary like a supermarket chain. So your relationship, your stakeholder base is expanding. Risks are expanding because one more player to deal with. Paolo has just started to consider whether the new products would be made in-house in a small production facility or production would be outsourced. There are huge repercussions of this, and I can see lots and lots of permutation combinations around this in the exam. We'll cover them slowly. So this is a significant strategic diversification for us, moving from restaurant services to food manufacturing and retail. Completely new different model, completely new product development, completely new, let's say, life cycle of the product. Your short term decision making, whether you accept this venture, whether you reject this venture. They can give you a scenario in the exam that, okay, if we accept this venture, they'll give you a table. These are the numbers. If we reject, these are the numbers. What should we do? So your short term decision making principles come into the picture over here, where you'll tell them that, okay, we should look at only the incremental costs, the incremental benefits, so on and so forth. We will test this within our mock questions as well, but I'm just giving you a light bulb idea. Now, early market validation exists because there is early demand signals. Supermarket has already reached us. You will need to consider the relevant cost and relevant revenues of this business. What will be the extra costs that we will incur. So relevant costing also being tested over here as a topic. New receivables relationship, your credit terms, your working capital impact. So your working capital also being tested. Very important is outsourcing. You are deciding whether you will make these in-house or somebody else will make them for you. You will brand them and you will sell them. So what are the benefits of outsourcing? What are the disadvantages of outsourcing? One of the most directly examinable topics which often come up. So outsourcing also being tested. You'll see in this one paragraph itself, we have so many topics. The life cycle, short-term decision making, relevant costs, receivables relationship, outsourcing. We still have new make or buy decisions. Should we make it in-house? Should we buy it? So that's your outsourcing decision pretty much. If you're making it in-house, you will need a new production facility. So you'll have to buy in or you'll have to lease in equipment. IS 16, IFRS 16 also being tested over here. Now the most important thing I want you to take away from here is new cost object entirely. Dip production has different cost drivers to restaurant meals. So might need us to introduce a new costing system. So a shift, from your current costing system to activity-based costing can be considered, can be a situation which comes up in the exam because this is a completely new production line for us. Because you are shifting your costing system, you will have to change your budgeting system also. So new budgets will be required, new different budgeting techniques to be validated here. Let's say we use a zero-based budgeting system. These are very clear exam situations which can come up, and I'm directly giving you these topics so that you make your points or make your topic list even more solid. This was very important information that is being given to us. Please pay attention to this, everybody. Next, restaurant operations. See, up until now, we were speaking about menu and product development, which is directly related to Paolo. Now, we are moving to restaurant operations directly related to Sofia. So, as at 30th April 2026, SoPa has 9 restaurants operating. 6 of these are located in Tombor, the capital city, and 3 in different major cities. We know this. A 10th restaurant is due to open on 1st July in a region of Zealand where we do not operate. So our city-wide expansion away from Tombor is continuing. So 10th restaurant already opening. So there will be, capital commitment already made over there. IS 16, working capital, all of these situations coming to the picture. But now because this new restaurant is opening up in a new area, new geographical market, it's an unknown customer base. You have limited historical data. So forecasting methods such as your expected value, standard deviation, sensitivity analysis, stress testing, all relevant given higher uncertainty for a new region. They can tell you that, okay, we are opening up this new restaurant, but what if, or how can we use sensitivity analysis to predict, or sensitivity analysis for us to forecast the revenues that will be generated. For example, I'm just saying. So the use of expected values, the use of standard deviation, sensitivity analysis, stress testing becomes very important for you. They can also create a payoff table on this. They can also say that, okay, how, because of this new restaurant, we want to decide at what level, what amount of ingredients should be bought. So they will present you with an already created payoff table. They'll tell you that, okay, according to Maximax, let's say the managers are very optimistic. According to Maximax, which particular ingredient level should be chosen for buying in. So you'll need to know the Maximax decision criteria, the Minimax, the Maximin, the Minimax regret. You'll have to know these decision criteria. You'll have to know how a decision tree is read. What are the different, what does a circle mean? What does a square mean? What are the different parts of a decision tree? You'll need to know that. Because, while we are going through the pre-scene, I'm giving you the important topics, but I'm also telling you how they can be tested. So that's how you can focus on your revision. That's restaurant operations. Continuing. There are currently no restaurants in countries other than Zealand, although Paolo has been investigating the possibility of opening a restaurant in Zealand, a neighboring country to Zealand. This would be the first venture outside of Zealand. See, we are learning so much about the company over here. We are learning that the company wants to expand. The company wants to, for expansion, we are coming up with new dips, a new product. And we are also going for geographic expansion. So much happening together, your finances are going to be tight. So first, international expansion. So new tax laws, new tax situation coming into the picture over here. So a lot of qualitative factors will have to be kept in mind when you are making this decision. Your cultural differences, your brand risk, whether your management has the capacity to give time to opening a new restaurant, plus also going into the Zealand market. So this becomes an important situation for us to keep in mind, especially with our current corporate structure, which is very functional, and also with directors having so much to do already. Will we have the time to look at dips, new restaurant, plus Zealand expansion? A lot of scenarios coming to my mind, a lot of risks coming to my mind, a lot of investment analysis, forecasting, budgeting coming to my mind straight away. Each restaurant has the same menu and the same feel in terms of decor and ambience. This is common. This is simple so that we maintain our standard costing, so that we, keep in mind our consistent decor. So good buying, bulk buying can be done for your property, plant, equipment, whatever is needed. One very important thing I want to plug in over here is better cost control is also possible because of this standardization. And a lot of exam scenarios are now giving the cost transformation model importance. So they'll tell you, okay, for our business, how can we use cost transformation model to make sure we are more tight in controlling our costs? So you should know the cost transformation model from your P1 syllabus area. Next, each restaurant has a restaurant manager who is responsible for two distinct areas. We already know this. He is responsible for each restaurant is its own responsibility center or a small business. Let's put it as that. So manager is responsible for kitchen and front of house. The kitchen includes temperature controlled ingredient storing, dedicated food preparation areas, cooking areas, and a front pass where the head chef checks the food before leaving the kitchen. And in the kitchen, the employees are the head chef, the sous chef, other chefs, and kitchen porters for dishwashing and kitchen cleaning duties. Standard. It's giving you a picture of how many people are involved. Then we have front of house. This includes customer dining tables, the bar area, and the front reservation stand. The employees include the front of house manager, ultimately in charge of all aspects of customer service, the bar manager responsible for the bar, the bartenders for making the beverages, the server manager in charge of servers, and then the servers themselves. So many people are involved in one restaurant itself. If you just go to a restaurant, you'll always see 25-30 people, involved in the running of the restaurant. Why? Because that's only there so that the customer experience is good, so that the consistency is maintained across a brand. Okay, let's do some quick analysis. Kitchen operations, multiple dedicated areas. So it becomes very important to make sure, because it says temperature controlled, significant overhead costs is the energy, is the maintenance costs. So these are all areas where costs will have to be controlled. IS 16 also coming into the picture. A front pass is also present. So you'll see our importance on quality. Because front pass, yes, it's there within every organization, but we are giving importance to that. So our cost of quality, our appraisal costs, because this takes time, head chef is doing it by himself. That is why people keep coming back to our restaurants. So our quality is being invested on in the business. You'll see we have prevention costs as well, high ingredient costs because they are sustainable. We have appraisal costs as well because head chef is checking each dish before it goes out. So our commitment to quality is very clear. For kitchen employees, we have the head chef. Obviously, this is, all of these people involved, the head chef, the sous chef, clearly brings in the labor, the labor rate discussion, because all of these people are skilled, right? The head chef, the sous chef is skilled. Your lower staff, let's say the servers or the bartenders, I will call them, some bartenders definitely very skilled, but the servers, I will call it as a job that you can learn on. For a head chef, you obviously have to study, educate, learn the process. So these are more skilled laborers, labor related jobs. So essentially, labor rate variance becomes important over here. So everything related to your labor variances, rate variance, efficiency variance, idle time variance become important over here, because we want to make sure that we try to control the costs as much as possible. So kitchen porters, these are the low skilled, low paid jobs where there is going to be high, turnover. The rate variance still remains important. Again, front of house, dining tables, bar area, reservation stand, 3 distinct revenue generating ideas: your dining, your bar, your reservations. Each area has different cost drivers. So there is the potential move to activity based costing, which can be considered because different costs are being driven by different activities. You cannot have one standard costing system for the entire business, because if you look at it, different costs are involved in making a beverage, different costs are involved in, the reason for the cost occurring is different for a beverage, the reason for a cost occurring is different for a food item. So activity based costing could be a scenario that comes up. Each restaurant is open to customers from 12:30 p.m. until 11 p.m. each day, with orders for food taken from 12:30 till 9:30. Kitchen employees work either an early shift starting at 8 a.m. or a late shift starting at 4 p.m. Front of house employees also work either an early or a late shift, although start time for an early shift is 11 a.m. So they're just telling us how the staffing is scheduled. Why? For your labor variances. We have already seen that labor variances are important in our business because of the number of levels of labor which we consume. But over here they clearly tell us that the kitchen staff start 4.5 hours before the restaurant opens. So there is significant idle time cost built into the operations, because until the restaurant opens there is no real serving that's happening, or no real making of food that's happening. All of this is early prep. So early shift preparation time is your fixed labor cost regardless of covers served that day. So your idle time variances, how your unproductive hours before the actual revenue begins is being utilized to make sure that the revenue is multiplied on, or the quality is good once the restaurant opens up, is an important consideration. Revenue at each restaurant is driven by the number of covers, where a cover is defined as a single customer. So they're telling us that the number of customers which come in drives my revenue. Each restaurant has 100 seats, and through the day each seat is expected to be occupied an average of 3 times, which means that the maximum number of customers per day per restaurant is 300. It is also expected that across the year on average, the actual level of occupancy will be 85%. So cover is equal to the primary revenue and cost driver for SoPa. Everything, your food costs, your labor costs, your overhead costs, ultimately tie back to the cover. So if we were to move to activity-based costing, you already have one of your major drivers in front of you, which is your number of covers. When we go deeper into the pre-scene, we will analyze our financial statements. While looking at the financial statements, we'll try to see which costing system SoPa follows, but this is just an idea for us to keep in mind. The maximum capacity is 300 covers per day per restaurant. This is my limiting factor. Seats are scarce. So let's assume that okay, there is demand. 300 covers per restaurant is your limit. You cannot have the 301st cover. So it becomes very important to make sure that we maximize the contribution given the fixed seating capacity. The customers which are sitting, we need to make sure that we maximize our contribution, not just the revenue, but we need to maximize the money earned, the profit earned for the business, because this is limited. The covers are limited. So your limiting factor decisions coming into the picture over here, your P1 syllabus, and also break even point. How many covers per day are needed to break even per restaurant? They could very simply test this in the exam by giving you a break even chart. They will ask you to read the break even chart. They will ask you to tell them what the break even chart means. It can be very simply tested just because of this hint which has been given to you. So total maximum covers across all 9 restaurants is 300 into 9, 2700 covers per day. 85% occupancy is 255 covers per day. 15% unused capacity is your opportunity cost. This is where dynamic pricing could be used, or let's say new schemes, new marketing techniques could be used. So dynamic pricing is something which you can consider over here as new marketing techniques. The mix of customers is roughly 60% who live within the city of the restaurant and 40% who are visiting the city. So you have locals plus you have tourists, or for work, whatever. There is significant brand loyalty, and currently around 70% customers are returning. So brand loyalty is very important for us to capture and make sure we take it ahead also, because brand loyalty is what keeps a business alive. So customer feedback is encouraged, and a QR code is available on the bill to allow customers to do this. In the early days, customer reviews were typically very positive about the food and service, with many 4 and 5-star reviews. These early reviews helped to build the reputation of SoPa, which in turn allowed the company to expand. Over the last year, reviews have become varied. So first sign of concern coming up now. Now digital feedback mechanism exists. You have a QR code, which means you are taking in digital feedback. But then what are you doing about the feedback? Okay, you have the feedback. Are you storing it? Are you analyzing it? Do you have any techniques? Do you have any analysis, mining which is going on this data to serve your customers better? So big data comes into the picture over here. How you use big data? Are you using big data? What is the opportunity available to mine the data, to analyze the data, to serve our customers better? Since reviews have become more varied, it's a red flag. Could be linked to our rapid expansion. You still want to go into dips, you still want to start geographical expansion when your current country's reviews itself are facing an issue. So your operational variances will have started to decline. For example, in your operations, in your quality, in your food service, in your let's say the overall experience, it must have started to go down, and the operational variances may have shown this already. We have not acted on it, and that is why reviews are now piling up. So your operational variances, P1 syllabus, your costs of quality, you have obviously let something down in terms of your quality, and that is why there are negative reviews comes into the picture. Again, P1. Currently, SoPa does not do any form of home delivery. Okay, we want to start dips, but the major growth aspect and factor within this market, which we learn in the industry analysis very clearly, is home delivery or takeout service. That is what we don't do currently. At a recent senior management team meeting, it was suggested that the company consider setting up a home delivery service. Now you have so many options. What are the chances that you will be able to fulfill all of them? Let's go ahead with dips. Let's go ahead with geographic expansion. Let's go ahead with setting up a home delivery service. Will you be able to do everything simultaneously as a business? This is a major decision, a major consideration for your business, and a scenario I believe is expected on this. SoPa is entirely dine-in. This means SoPa is missing out on the fastest growing segment. Yes, they are looking to start in Tombor, which is a sensible starting point. However, delivery requires entirely different operational capabilities than a dine-in. So when you are forecasting for this new project, a zero-based budgeting system should definitely be considered, because you are starting a new system, a new product from zero. This would necessitate the setting up of ghost kitchens. That is a kitchen entirely for the preparation and cooking of home delivery food. The SMT is in the process of considering this further. So we are considering this as a new opportunity where we set up the ghost kitchen. This ghost kitchen then deals with your home delivery orders. So ghost kitchen is also your significant capital investment. It's a new fixed cost. So your IS 16, IFRS 16 come into the picture over here. Your investment in working capital also comes into the picture over here. So your F1 syllabus, very, very prevalent. Ghost kitchen assumes in-house production, but delivery itself could have its own drivers or third-party platform. Third-party platforms charge commissions. So your relevant costing decisions, whether you want to build your own platform, your own delivery staff, which is obviously expensive, or you want to partner with delivery apps like Deliveroo or Zomato, wherever in the world you are. You have different delivery apps. Do you want to partner with them? Do you want to build your own? Your relevant costs, your minimum pricing decisions, P1 syllabus coming into the picture over here. Now, one very important consideration and just a thought coming to my mind is that we do not have any digital products. Classic or a classy unseen setup for the exam task. they could bring up a scenario where they say, okay, there are new digital cost objects. Unlike dine-in, where the cost object is a cover, digital delivery creates a new cost object, the delivery order. When an order is placed, that's how the cost is driven. SoPa must identify and track entirely new cost elements. Third-party delivery platform commission or own app development costs. They can tell you that, okay, for this service, we are developing our own app now. Or we are partnering with third-party delivery platforms. In either case, there are costs. Digital payment processing fees, there is online order management, there is customer data management. All of these costs create digital requirements for a company. So digital costing can very much be tested in the exam. They can ask you, okay, what will be the challenges if we go ahead with this new digital costing system, for example? You list the challenges. This is in your P1 syllabus and a very favorite exam topic and very relevant for our business. That is why I am discussing it. Same way, you can have, let's say, SoPa branded dips, digital retail costing. If sold directly to customers online, you will need a website which needs to be managed. So you will need digital marketing, you will need payment processing, all of which needs to be considered. So your digital costing is going to be very important for this business, and it's also an important topic for the exam from your P1 syllabus. I've given you 2 task examples as well, which are coming up in the exam. In the past as well, they have come up. So let's say they can tell you, prepare a briefing note for Raj explaining the cost information SoPa would need to collect before launching its home delivery service, and discuss how this costing, how this differs from costing its existing dine-in operation. So what information would you need? Think about that. How does it differ? We already know it will have a different cost driver. Let's say delivery order placed. It will have different tracking mechanisms. Now when you think of these tasks, when you're doing your P1 revision on digital costing, it gives you direction. It gives you areas of focus. It gives you what you need to focus on. Same way they can ask you, evaluate the challenges we would face in allocating the costs of its proposed ghost kitchen across Tombo restaurants and recommend suitable costing approach. So what will be the challenges that we face? We have no historical data, we're sharing the infrastructure, how to allocate the costs fairly, how to identify the costs fairly, because digital costs are not easy to define. All of these ideas you can keep in your mind and revise digital costing from your P1 syllabus, because these are topics which are coming up again and again and again in the exam. We will test you on these within our mock questions, so don't worry about that. But while doing the pre-scene itself, I want to give you ideas. Next, we are moving to ingredients and suppliers. So we were doing operations. First we did the menu development, then we did operations. Now we are going to ingredients and suppliers. So the main ingredient groups are fresh meat, fresh fish, eggs, dairy, fresh fruit and vegetables. Pretty standard, everything that you can imagine a restaurant needs. No frozen ingredients are purchased, because remember, we are focusing on fresh, we are focusing on sustainable. In addition, the company has to regularly buy in restaurant supplies such as napkin, glasses, cutlery. So multiple ingredients, naturally material variances come into the picture. So your material price variance, material usage variance, overall material variance coming into the picture over here, because there are so many ingredients which you need. Now we have a fresh only policy, which means ingredients will have a short shelf life. So managing of inventory becomes even more important. Inventory management techniques, P1 syllabus, become even more important over here, because you need to consider the costs of holding high inventory, the costs of holding low inventory, your just in time inventory approach. This needs to be considered because you need everything fresh. You also have non-food consumables, which are your indirect costs, like your napkins, glasses, crockeries. So IS2, restaurant supplies, held as inventory until consumed? How do we record them? What is the the net realizable value versus the fair value? How do we record them? Your IS2 rules become important. I've already discussed inventory management as a major topic for us. The number of suppliers and average suppliers credit terms have been given. So fresh meat, we have 3 suppliers. Credit terms are 30 days. Fresh fish, 1 supplier, 15 days. Eggs, 2 suppliers. Dairy, 1 supplier. Fruits and vegetables, 4. Dry ingredients, 5. And supplies is 2. Now some things coming to my mind. Single supplier for fresh fish and dairy. What if tomorrow you have a problem with this supplier, or this supplier cannot supply on time? Your entire operations will suffer because you are a fresh only policy. So single sourcing versus multiple sourcing. Benefits, advantages, disadvantages. E1 syllabus. These are qualitative factors in decision making. E1 syllabus comes into the picture over here. If I do a credit analysis, fresh fish is 15 days, shortest credit. So fast cash flow will be needed. So because you will have to generate that cash and play this supplier quickly. Eggs 20, fresh meat 30 to 60 days generally is ideal. But 15 and 20 days raises a cash outflow requirement which you will need. So if you don't forecast properly, if you don't manage properly, there could be a cash issue within the business, because 15 and 20 days are a short cash cycle which you need to be aware of and plan better. Now overall you have 18 suppliers and 7 categories. So management of these suppliers, relationship management with these suppliers, having a solid payment timing for these suppliers becomes important, because this is a major risk area for us. All restaurants receive supplies direct from suppliers. There are no central storage. So decisions are made centrally, but there is no central storage. It goes directly from the supplier to the restaurant, so it's fresh. Currently, many of the suppliers supply all restaurants. In a bid to reduce food miles, the SMT is now looking into widening the supplier base. So even more suppliers, not only 18, it could become 30, 35, 40, anything. So local suppliers are used so that food miles are minimized, so that again your sustainability credentials are strong, your green impact, or let's say your carbon impact is less. So okay, sustainability being supported, but you will have it will also reduce costs maybe, but it can have an effect on your overall let's say ingredient quality. There is that risk, right? So direct delivery to 9 sites. So 18 suppliers, 9 restaurants, up to 162 supplier to restaurant relationships to manage. There is no central warehouse, so there is no bulk purchasing advantage, no buffer stock. Your material requirement planning, economic order quantity could be tested over here to make sure that inventory is managed properly. These are inventory management systems. We've already spoken about it. Now moving to local suppliers is equal to different prices per restaurant, but for the same ingredient. Your standard costing system will now go for a toss, because every restaurant will have, if we do this, will have different costs of procurement, because everybody is not going to sell at the same price, right? This will also give rise to material price variances, which will have to be explained. Plus this could also mean that we are moving, or we could consider the move to activity based costing, because standard costing will not be very standard for us anymore. The SMT is also considering ways to connect more directly with farmers and growers in order to improve the provenance of ingredients. It is even considering whether it would be feasible to set up its own growing operation for salad ingredients using a vertical farm. Another new thing the company wants to do. Remember, at the industry analysis, it was very clearly mentioned that the reason for failure for many companies is doing too much too quickly. I feel SoPa is pretty much considering a lot of different things at one time when our customer reviews are currently declining. First, let's become an expert in what we are doing. Then we can think about dips, geographical expansion, supplier, changes. Then we can think about setting up our own farms. So, okay, having direct farmer relationships, I can understand that it's cutting out the middlemen, it's better sustainability, it's direct, more fresh produce. I can understand that. But a vertical farm is significant capital investment already and an entry into completely something which you don't know. So SoPa would move from pure service business to partial manufacturer now, because you will be making dips, you will have your own farms, a lot of manufacturing is being involved now. So your costing system becomes more and more and more technical. Standard costing might not suit, so activity based costing makes more sense. You could have, if the vertical farm underperforms, let's say you start it underperforms, there becomes a question of a shutdown decision. So you need to consider its relevant costs, whether I should keep running it, whether I should not keep running it, because there is a chance that it doesn't work, right? Also, a lot of risk, a lot of uncertainty. So standard deviation and sensitivity analysis coming into the picture, crop yields, energy costs, weather, all introduce significant uncertainty around which scenarios can be tested, because all by itself the nature of this new venture which we are planning is risky. This also brings about one of the most famous and favorite and dreaded exam topics, which is LPP, linear programming problem. I've given you a situation of how they can ask it and how they have been asking it. So scenario 1, let's say limiting factor is fresh ingredient supply, and LPP is used when you have more than one or two limiting factors. When you have a lot of limiting factors which you want to consider together and make the best decision for your company, LPP is used. So fresh fish sourced from a single supplier with 15 days credit terms. Supplier cannot meet demand across all 9 restaurants. Fish becomes a scarce resource. For example, the linear programming problem would help you determine the optimal dish mix that maximizes the contribution given the limited fish. Because remember, you have only 300 covers. Out of these 300 covers, you are supposed to not maximize your revenue, but maximize your contribution, which means the amount that the business earns, the profit that the business makes. So LPP will help you understand which dish you must sell first to get the highest profit. So you might maximize as we go deeper into the pre-scene. They'll give us what different dishes we sell, what different profit margins are for each of the dishes. But I'm just giving you a head start over here and telling you how LPP can be tested. So this will likely appear as, let's say you are given information about limited fish supply. There's an issue with the fish supply. Explain how SoPa should prioritize which dishes to serve and discuss the implications of the fish supply constraint on our menu. Let's say there is fish supply constraint plus there is another constraint. So keeping both constraints in mind, what is the optimum level of XYZ dish? Because that's our product, right? So XYZ product which we must produce to maximize contribution. They will say that, okay, dairy, let's say for example, also multiple constraints. Now let's see. SoPa faces simultaneous constraints: limited kitchen labor hours, limited fresh ingredient supply, and limiting seating capacity. All are limited. The linear programming problem model helps us find an optimal combination of which dishes we should sell. So this will likely appear as, let's say they'll give you 2 or more binding constraints, that labor is also limited. Now ingredient supply is also limited. So first I gave you the situation where there was one limiting factor. There can be multiple limiting factors as well, where pretty much LPP is used. And the limiting factor example here is labor hours and ingredient supply. So identify the feasible region graphically. They'll give you the graph. They'll tell you, okay, this is one constraint, this is the second constraint. which is the feasible region. Okay, read the feasible region, which is the optimal production mix. So your lot of opportunity for LPP to be tested. There can also be a scenario around the vertical farm where they will say, okay, farm is being set up, these two other constraints. Ghost kitchen is being set up, these two other constraints. Any constraints can be tested in linear programming problem. It's a favorite exam question which keeps coming up. Now we have been given a full section on sustainability. So obviously sustainability is important to us. If they didn't give this also, we knew it because of our past, let's say, discussions on sustainability. Paolo and Sofia have a personal interest in protecting the environment. Okay. However, they recognize that operating a restaurant does have negative impacts on the environment, especially with respect to energy consumption and food waste. We are already trying to limit sustainability issues with properly sourced, sustainably sourced ingredients, plus limiting food miles, direct with farmer relations, but there is still energy consumption and food waste. This is our founders' values, this is our core. Sustainability related KPIs will be very important for the business to track because we are concerned about it. Where possible, they seek to mitigate these impacts by ensuring that tables and chairs in restaurants are made from wood, which is sustainability sourced. Napkins and menus are from recycled paper. Ordering fresh ingredients to limit wastage. Using, where possible, energy efficient equipment. Sourcing electricity from a green supplier. So now, see, remember all of this again. Point 3 of why we are doing this pre-scene, so that you can use this information when the time comes. If you don't use it, all of our work that we are doing right now goes to waste. So when you are writing anything in the exam, keep in mind that okay, we have committed to sustainability. Use it. Keep in mind that the operations director is responsible for this. Keep in mind that okay, this is how the business is run. These are the avenues the business is looking to expand in. All of this you need to use when the time comes within your mocks, and trust me, just by going through these videos 2 times, plus reading the PDF whenever you get a chance, whenever you get an opportunity, automatically you'll remember this stuff. Don't try to learn anything, but keep going through it so that it adds value. When the time comes, you will be able to use it, but you need to be aware. Keep going through it. Now, because we are focusing so much on sustainability, it will be a cost premium that we will pay. So it becomes very important for us to make sure that this premium is then passed on to the customers, which we know because we are already sitting in the middle. We are not those cheap restaurants or not a highly fine dine restaurant. We're sitting in the middle because these costs are passed on to the customer. So energy efficient equipment also costs higher, but it's something which we are paying a premium from. The green energy tariffs is something that we are paying a premium for, to maintain my brand differentiation, to maintain that okay, I am different from what's out there in the market. Next, employees. Paolo and Sofia have built a strong senior management team that is based on the company's head office located in Tombor, the capital city of Zealand. This team is supported by junior managers and assistants. The whole team of 30 employees based at the head office is passionate about food and about creating fabulous dining experiences. These are my core values. Centralized management team supporting 9 restaurants. Each restaurant is headed by a restaurant manager, and each has a further 30 employees. 30 at the head office, and each restaurant has 30 employees. It's split as kitchen having 16, bar having 3, and front house having 12. So majority are in the kitchen. So 9 restaurants, roughly 31 employees. 30 employees plus 1 restaurant manager. So 279 employees plus 30 at the headquarters. There are total of 309 employees. So again, standardized across each restaurant. That is why standard costing has been used. Now the kitchen has 16 employees per restaurant. Largest single employee group. The kitchen is the biggest driver for direct labor cost. Managing this will be very, very, very important. Now the bar has a small team, 3 employees, but in our drinks menu, it showed that we charge $3 to $15 per item. So bar revenue is entirely incremental. This will be a major revenue generation item for us. 3 employees. We will need to see if more employees are needed for this, because this is a major revenue generating area for the business. From the early days of the company, Paolo and Sofia recognized the importance of a happy workforce. Very clear. Workforce is not happy, they will not serve customers well, which will be a classic problem for you of not being able to scale more because your current reviews are going down. They've always sought to ensure that employees are paid a fair wage, given adequate training, and not overworked. As a result, employee morale has always been high. So maintaining morale always requires investment in wages, training, working conditions. So how do we set our budgets? Do we involve everybody? Participative style, imposed style. Pretty much right now there is a central structure. So it would be an imposed style system which is being followed. A more participative style. A style where everybody is involved, brings in more buy-in, brings in more effort, interest from the employees. However, given the increasing number of restaurants to manage, Paolo and Sofia alongside Lu Chen are finding it increasingly more difficult to maintain a high level of employee morale. Morale is going down, that is why reviews are also going down. So managing this problem will be very, very important for our business. Now some scenarios where favorite exam questions, break-even chart we already discussed. So let's say SoPa has clear fixed costs and variable costs. They can tell you that, okay, we are this is the break even for a new project or our current projects or our current restaurants. Can you help me read it? Can you help me see how it will change if a new product is added? No, whatever. This is break even charts, classic test in the exam. Same way they can ask a profit volume chart. This shows contribution earned per cover at different occupancy levels. They will tell you that, okay, useful for evaluating your ghost kitchen proposal. At what delivery volume do we break even? They'll give you, okay, a new ghost system, a new ghost kitchen is being introduced. They'll give you a profit volume chart. Okay, where is the break even happening? How do we read a profit volume chart? P1 syllabus. Also useful for evaluating 10th restaurant. Multi-product break-even chart. Very favorite again exam question. These charts are very much tested, and that is why I'm giving you the scenarios to keep in mind of when you are revising them. SoPa effectively has multiple revenue streams. Each has a different margin. The multi-product break-even ranks products by their CS ratio, contribution to sales ratio, and naturally you should sell the product or promote the product which has higher contribution to sales ratio first, because that's giving you the highest profit. So they can tell you, okay, applicable across restaurant segments, Tombor restaurants versus out of city restaurants, or let's say something new is introduced, let's say dips are being introduced. So how will the CS ratio change? How will this affect the multi-product break-even chart? They might give you the chart, they'll ask you to read it, they'll ask you to tell them why the chart is changing or why the line is changing on the chart. All of this becomes important, and if you have revised these concepts, when I test you on them in the in our mock questions, then when you write it, then when you learn from the model answers, automatically your topic is being revised, your pre-scene is being revised, your writing is being revised, everything will get revised. But it's important that you go through these topics as part of your revision structure as well. Next section, recent customer reviews for SoPa restaurants. I'll just quickly go through the overview. You'll see that there are varying reviews. 5 stars, 4 stars, 5 stars, 1 star, 2 stars, 3 stars. Some are liking it, some are not liking it. very clear within the reviews. I have made an analysis. So if I count the reviews, you'll see that there are 6 5 stars, 2 4 stars, 2 3 stars, 4 2 stars and 2 1 stars. 50% of the revenues are 4 to 5 stars, confirming the earlier statement that reviews have become varied. The positive themes are that the food quality is good, flavor is good, atmosphere is good, some staff are good. The negative is that staff stretched too thin, which means they were overwhelmed. There were less people. Food temperature and timing issues. Food arrived cold. Not good. Sorry, just scrolling up. Poor complaint handling. There was a complaint. It was not handled. Atmosphere inconsistency. Now this directly links to cost of not following high quality internally. Now there are internal failure issues, external failure issues, customers are being lost. Now weaker reviews were from newer out of city sites. So we are not able to manage restaurants out of Tombor. So maybe we haven't done a strong analysis of that market. Maybe we are not able to control well. Maybe we are not able to understand the variances. And you still want to expand geographically. You still want to introduce dips. You still want to do some new stuff. I feel we should first deal with the problem of these varying reviews and then take it from there. This will be the end of part 2 of our analysis about the company. Part 3 is the financial analysis section that I will begin with you. But before that, very important to get a hang of these details which I explained in part 1, in part 2, make your topic list, make sure you revise the topics on the topic list, then you begin with part 3, not because it's ready and given to you. That's part 2. For any questions, always available. Thank you. Now to part 3. One of the most dreaded parts and one of the most ignored parts, I would say, because not a lot of students pay attention to the numbers, to the financial statements, to the budget information, just because it's too overwhelming. My suggestion is that this part you will need at least 2 to 3 go-arounds, go-throughs. Only then these numbers will make sense to you. Otherwise, you'll get pretty much overwhelmed by all of the numbers that I hear if you don't let the information sink in and if you don't understand the information that has been presented. So in the financial analysis section, what we will do is, number 1, we will take the actual numbers which CIMA has released. The actual exact financial statements we will take, and then I will present my analysis on those financial statements for you. First, we will discuss the actual numbers, like on your screen. Then we'll discuss the analysis. Remember the 3 reasons why we are doing such a detailed pre-scene. Always keep this in mind. Number 1, to understand my company. Number 2, to make a solid list of revision topics E1, P1 and F1. And number 3, so that I can use this information when the time comes, and using this information, using this financial information when the time comes will completely change your answer. I can guarantee that for you. So you will tell me, okay, am I supposed to remember all of these numbers? That's absolutely impossible. I know that even if you try to learn, you won't be able to learn. And I'm never asking you, never expecting you, and the exam also doesn't do that. I will give you tips of how you can use these numbers as we move on, but keep this in your mind. The more you use information about your company, which is there in this pre-scene itself, within your answers, the better your answers will become, the more marks you get. Let's keep this in our mind. So first, let's start with the statement of profit or loss. Now the year end over here has been kept very simple. They've kept it 31st December 2025. So the year has just ended. There are 3 months which have passed in this new year. You need to keep in mind that the year end for SoPa is 31st December 2025. So okay, They gave us revenue. We already know that our revenue was around 41 million. That's been further given to us over here. But they said that last year it was 36,240. So a strong revenue increase. Cost of sales also went up, but the revenue went up by a higher margin. It's very much evident and very much visible over here that the revenue has gone up by a higher number than the cost of sales, which means you were able to control your direct costs, your ingredient costs, you were able to control. And that is why you have made a healthy gross profit compared to last year. It was 11 million, it came up 11.5, it came up to 13.5. So a good gross profit increase, the market is growing, SoPa is growing, good. Marketing costs went up little bit, I won't say a huge increase. Admin costs went up, and I will say this is something that is considerable, almost 700,000 increase. So maybe, okay, we were able to control our direct costs, but the indirect costs such as marketing, such as admin are going up, which we need to keep in check, which we need to understand better so that we can check them. Maybe a different costing system will help us understand these costs better so that we can control them. Just an idea. But still, our gross profit had gone up. So essentially, there was an increase in the operating profit. Finance costs went down. 365 became 350. So there can only be two reasons for finance cost going down. One, you repaid a part of your loan, so you don't have to pay interest on it. Number two, the interest percentage declined. So we'll see what happened over here as we go to the financial statement and as the cash flow statement. But right now finance costs have gone down, not a very considerable number. So I will move on. Now all of this leads to still a very healthy profit before tax of 3570, which is carrying forward from the solid gross profit that we had made. And at the end of the year, you pay your tax. Your income tax has gone up. Income tax generally goes up. If you make more profit, you pay more tax. So income tax has gone up because the profit had gone up, and the profit for the year is still a good increase from last year. So the company's financials are positive. They are moving in the right direction. Direct costs have been controlled. Indirect costs have slightly gone up, something that we can understand better. So essentially, I will say that it's something, there's not something that's very alarming within this profit or loss other than the company is moving in the right direction with a revenue growth. Just a note that this revenue has an asterisk, which means that the average number of restaurants is treated as 8.5 and last year was 7.5. The company opened a new restaurant on 1st of July, so half of the year. From January to end of June, they take half the year's revenues within consideration. Since the company opened a new restaurant on 1st July, the new restaurant only operated for 6 out of 12 months. From July to December, it operated, right? So I count the revenue and I count it as 0.5. There's just some technicality which they're giving you. Okay, now my analysis. See, it's pretty much going to be impossible for you to remember the exact numbers which have been presented. You will not be able to remember, okay, profit before tax was 3570, last year was 2385. You have so much to remember, you're not going to be able to remember these numbers. So what we do is we make your life simple and we have calculated percentages for you. If you look at these percentages, you will see that revenue has gone up by 15%. Now these are numbers, some of these numbers, I'm not saying all of these. Some of these numbers you can try to remember and you can try to use within your answer. Same like manager names, same like the country's diversification ideas. You can keep in your mind that okay, our revenue has gone up by 15%, seeing that okay, we are in the right path, right direction, maybe now is the time for diversification. For example, you can include and plug in these numbers over there. It will add marks, add value. And I'm not saying remember all of these. I've highlighted 2, 3 for you. Just try to remember any one or two of them and use them. One from the statement of profit or loss, one from the financial position, maybe one or two from the cash flow statement, and use it when the time comes. And don't even learn. When you go through the financial analysis multiple times, automatically one or two things will set up in your mind. But you need to know that okay, it's there in my mind, but I need to plug it in my answer when the time comes. So okay, revenue has gone up, but it's gone up by a bigger percentage than the cost of sales. That is why my gross profit has a good solid increase, 17.58%. The margin from last year has also increased because the revenue has increased. Marketing costs went up. We already saw that by close to 15%. Maybe we marketed more, which was successful, and that is why revenue went up. So good sign, right? That my marketing is working. Admin expenses also went up. Remember, we can try to understand these costs better so that we can control them. But all of this led to a healthy increase in operating profit of close to 40%, from which your finance cost further decreased. So essentially, your increase in profit before tax was close to 50%. A very good, strong, healthy number. So essentially, what we are seeing is our company is showcasing strong profit numbers, strong growth numbers, and maybe that is why the management is now deciding to expand, diversify into different avenues. But also keep in mind that our reviews have been more varied. Okay, tax rate has remained the same pretty much, effective tax rate, which means that you earned more profit, that is why you paid more tax. Our margins have shown an increase, which means we have been able to control the costs, which is very clear over here. Revenue has gone up, but costs have also gone up, but not by a very exponential percentage. So we have been able to control the costs even though they have increased, and that is why we have strong, healthy margins. So from the statement of profit or loss, what I saw was revenue went up, gross profit went up, margins went up, costs went up, but by a small proportion in comparison to the profit or to the revenue, and that is why we have a healthy profit increase of close to 50%. A very good sign for our business. Now, everything that I spoke about, everything that I spoke of has been given to you in the conclusions over here. Why? Because when you will be reading this pre-scene by yourself, I don't want you to feel alienated and again go back to the video, because you won't have the time. That is why I have given you this in writing as well. So when you go through this, my explanations still make sense for you. That's my statement of profit or loss. Coming to the statement of financial position now, balance sheet. A very important aspect, because this showcases my assets and liabilities. So okay, let's look at it first line by line. So property, plant and equipment went up from 10.3 million, it became 11.4 million. There can be two reasons for this. We'll see the reasons in the cash flow statement also, but let's first speculate. Why can property, plant and equipment go up? Number one, you bought new property, plant and equipment, so the value increased. Number two, there was an upward revaluation. That is why value increased. Okay, next, current assets. Inventory, pretty stable, 214, 230. Receivables, 165, 150. Cash, 1.1 million in cash, and now 1.4 million in cash. So okay, again pretty stable, but a slight increase. Total assets coming up to 13,256 for this year. Nothing again alarming, pretty standard asset side. Next, equities and liabilities. Issued equity share capital 400 remain the same. It's 100% owned by the owners right now. Share premium 1200. Retained earnings have gone up because your profit went up. It's added to the retained earnings of the last year. That is why your retained earnings have gone up. That brings my total equities to 7628. Now bank loan 1986 became 1812. Remember, in the profit or loss statement, our finance costs had gone down. Bank loan has been repaid over here. From 1986 it became 1812. So bank loan has been repaid. That is why my interest expense went down. Current liabilities, bank loan, the same. Trade payables. You'll see that my payables are a very large number. If you see my receivables, they're 165 and 150. Which means we have very less outstanding receivables. And what are these receivables? These receivables are nothing but the credit card payments which customers make at your restaurants. Because we can't have any outstanding receivables, right? Somebody comes to my restaurant, I can't ask them to pay me tomorrow. So what are these receivables? These are just the credit card outstanding payments which we receive in a couple of days once the bank settles it. So these are the receivables, but our payables are going to be large because of the different category of suppliers that we have, which we have already discussed, 15, 18 suppliers. So a large number of suppliers with different payable days. So our payables are a very large number, 1310 to 1450. And maybe that is why such a strong, healthy cash component is held with us. Otherwise, generally businesses will not, business of this magnitude will not have so much cash on hand. Why do we have so much cash on hand? Because we have pretty much zero receivables and our payables are large, 1310, 1450. Other payables 1450, 1290, and the tax liability has increased. So pretty much again the numbers are stable from last year. There are no alarming huge increases or decreases to worry about, but it tells us the nature of the business which SoPa is in. Next, just my analysis on this financial position. See, very important for us to see the ROCE for a business. It's going to be very positive for our business because we are making almost 50% of profits, 50% profit before tax. So ROCE is how much money is invested and how much return is being generated. See, eventually if the business wants to keep growing, the owners might have to sell some part of their shares. The owners might have to bring some more people on board, and they will only come on board if they see a positive business. So ROCE is a big measure for this. It increased from 32 to 41 because this year the profit is healthily increased. So ROCE is a great measure which you can use and plug into your answers when the time comes. Next, we have non-current asset turnover from 3.5x is became 3.6x. So this shows the restaurant network is generating more revenue per Z dollars of PPE invested. If you invest $1 in non-current assets, is giving you $3.6 of return, which is a very good, healthy sign for a business. Now my current ratio and quick ratio are of worry. I've given you an explanation here as well. The current ratio of 0.47 means that for every $1 of current liabilities, we have only 0.47 of current assets. The current ratio's ideal is 2-part asset, 1-part liability. Currently, we are 0.47 to 1. So on paper, SoPa falls significantly short of its current ratio. Same with the quick ratio. The quick ratio of 0.41 similarly falls well below the 1:1 ideal mark. It's currently 0.41:1, removing the inventory, which clearly showcases that cash position or cash crunch could be an issue. So working capital management is essential for this business. But this is on paper. Think of SoPa's business, guys. So these ratios do not signal a real liquidity problem for SoPa because SoPa is a cash-based restaurant business. Customer pays immediately. Suppliers grant credit terms of 15 to 60 days. So trade payables are sitting over there, but we are receiving cash immediately. Our cash is not delayed, right? So this naturally inflates the current liabilities, and that is why these ratios are looking bad. But still, the real proof of liquidity is the operating cash flow, which is 5239 from our, which we'll see later on in the cash flow statement. Let me just go to it quickly. You'll see cash generated from operations for this year is rather 6194. From this you still pay your tax. From this you still pay your interest. You get 5239. So you, from your operating activities, you are still getting in a lot of cash. So you are comfortable in that sense. On paper though, it might feel that SoPa is a cash, is going to face cash issues, but that's not the real issue because of the nature of our business. Otherwise, with such a tight current ratio and quick ratio, no business can really survive. Okay, so that's a important discussion for current and quick ratio. The return on assets has gone up, obviously, because income went up. Everything will be positive because your profit is positive and by a high margin. Gearing only has gone down. Why? Because debt has been repaid. So you were able to repay debt. You were able to still generate high profits, which showcases that the business has huge, solid, good growth potential. That's my statement of financial position analysis. Next, we have the statement of cash flows. This is the actual incoming and the outgoing of cash. Statement of cash flows. Let's start with profit before tax. 3570. All non-cash items will be added back. Depreciation is a non-cash expense, added back. Finance costs are added back. They are subtracted later on, but right now we add them back. And then profit on disposal of property, plant and equipment. There was a profit which was made. We remove this and our total comes up to 2645. From here, movements in working capital. Your inventory increased, which means there was more money tied up in inventory. So your cash went down. So minus 16. Decrease in other receivables. Receivables decrease. Addition. Decrease in trade and other payables. You have to pay. So negative. Cash is going out. Remember, this is a cash statement. Always think what is happening to cash. Payables, money going out. The total comes up to a negative 21. So your cash generated from operations is 6194. From this, you'll remove your tax. From this, you'll remove your interest. And then your net cash inflow. Because it's positive, it's an inflow from operating activities, comes up to 5239. That's operations only, running of restaurants. Second segment is cash flow from investments. Now there was a purchase of property, plant and equipment, so money went out. Again, remember our statement of profit, statement of financial position showed an increase in property, plant and equipment. Let's just briefly look at it. You'll see that the increase is close to 1 million, right? Over here, they have said that we have purchased close to 3 million of property, plant and equipment. So what would have happened? You purchased, but there is also always depreciation. the effect of depreciation. So you purchased, but assets still got depreciated. That's why you see close to 11 million on your financial statement right now. Back to the cash flows. This is purchase, so negative. You also sold some part. So this is positive because money is coming in. So cash flows from investing activities are a negative 3405 because money went out. From finance now, dividend paid to our shareholders, which are the two owners. So dividend paid and repayment of borrowings. There was a borrowing which has been repaid. So this also money went out. Dividend is also money going out. So net cash flow from financing activities is negative. So you'll add the two negatives, subtract it from the positive. So net increase in cash and cash equivalents comes up to 260. So 3405 plus 1574 minus 5239, you'll come up with a net cash increase because the increase number is higher of 260. What was cash at the start of the year? 1166. What is cash at the end of the year? Plus 260. So 1426 is your cash holding. This is how we read a statement of cash flows. This is obviously part of your F1 syllabus, so you should have already understood how I read the cash flow. But essentially everything that I spoke of has been put over here for you as text as well, so we do not miss out on anything important. The next is budgeting information. Very important, very critical, because this time they've changed it around. They've not specifically told us the costing system, the budgeting system, nothing. They've left it all in the dark for you to figure out, but you don't have to worry. We are here to assist you and put your thoughts in the right place. So, okay, they've given us the budgeted information for the year ending 31st December, which means this year, 3 months are already done. That we have to keep in our mind. Let's continue. So, firstly, first line is revenue. The budgeted revenue is 31,711 from food, from beverages, and that's my total. The direct costs have also been budgeted. And then very important hint over here is from the revenue, the direct costs, it clearly says direct costs, not full costs. So only the direct costs are removed. It brings you to profit after direct cost. Now, if you've done your P1 studies, you would very well know that from your revenue, if you deduct your direct costs, what are direct costs for you? Your ingredient purchasing, your labor costs, right? So let's say I removed my variable costs because these costs are only covered if the customer orders a dish. If the customer doesn't order a dish, I don't incur the direct costs. So revenue minus the direct costs gives me the profit after the direct costs, which is a very clear hint that these are, this figure is your contribution figure. This is, they've called it profit after direct costs, but it's essentially your contribution. Revenue minus your variable costs gives you profit after direct costs. And the more clear hint after this is in one block, in one line, they are removing your indirect restaurant running costs, the costs to run your restaurant, which is your rent, your salaries, your depreciation. All of this is deducted in one block. This is classic marginal costing because very clearly they have first given you the contribution, in other words, and then removed the fixed costs as one block. This is what we do in marginal costing, right? This brings your gross profit figure of 17,162. They are also giving you profit after direct cost margin. The margin for beverages is much higher than that of food. We already know that beverages, even without being in the restaurant industry, you know that beverages are going to be a major margin giver for restaurants. So this is a major product driving the revenue for us. We'll be speaking more about this deeper. But what I want you to take away from this table is It's a marginal costing style budget. From this, we can clearly decipher that the style is the costing system used to create this budget is a marginal costing system, sorry, because first a contribution is derived, then fixed costs are removed in one block, and that brings you to your gross profit. So this is marginal costing. You should have knowledge about absorption costing. You should have knowledge about activity based costing. Similarly, because we are speaking about budgets, I'll go deeper on and give you examples of different types of budgets as well. But right now, let's speak about costing. A little bit on the budget segment as well. Now, this is a fixed budget if you look at it. 2285 is presented as a single number for your indirect costs. So this is not adjusted according to activity levels. It's a fixed budget. So this is a fixed marginal costing type system based budget which has been created. A flexible budget. What is a flexed budget? A flexible budget would adjust for actual cover levels, making performance evaluation more meaningful. The number of covers, and then you multiply the indirect costs for the number of covers, then that comparison would be better. So rather than a fixed budget, the benefits of a flexed budget are also to be understood from this table. Two takeaways: marginal costing plus there's a fixed budget. So flexible budgeting is also often coming up in the exam. What it is, advantages, that also needs to be covered. So I'll just make a quick analysis on this table. Everything that I spoke about has been put over here in words. You'll see that from our total budgeted revenue, 64% comes from food, 35% comes from beverages. But very clearly, beverages have a superior margin. So beverage performance is therefore critical revenue driver, profit driver for our business. So after deducting indirect costs of 2285, the gross profit margin is 34.9, an improvement on 2025. The margin improvement is driven by both expanding restaurant base, more revenue, better operational efficiencies, because you were able to control your direct costs, right? We saw that in our earlier tables. So this is our takeaway from the first budget given to us. Next, they've given us total budgeted revenue and direct costs for food. This is the next item presented to us. So again, we have different products. See, all of these items are products for me. If it were a manufacturing organization, then pen, pencils, paper, these would be different products, for example. But we are a food business, so our different products are starters, main, side, dessert, total. So revenue from starters, 7570. I'll directly go to the profits because essentially that is what the business is defined by. Now if you look at, I want to make a comparison between revenue and profit first. If you look at the revenues and profits, straightforward, you'll see that the highest revenue is coming from mains. But does mains have the highest amount of profit? No. Mains amount to 71.4% after deducting the direct costs. Starters, on the other hand, are giving me 80% margin. So essentially, my highest revenue driving product is not my highest profit generating product. And this analysis tells us that I should know which is my hero product, which is my most selling product, which is my least selling product, so that I can suggest for my business accordingly. So revenue generated is 7570 from starters, but it's the highest profit driving product. Mains, highest revenue, but it comes, let's say, third in the profit race. Sides, second lowest revenue but lowest profit. Dessert, lowest revenue but third highest profit. So if I rank according to profit, it's starters, dessert, mains, and then sides. If I rank according to revenue, it's first mains, starters, side, and then dessert. So this tells you the position that the business is in. This tells you which is your hero product, highest margin, which is your most selling product, mains, which product there is an opportunity to sell more. All of this comes because of this analysis, and everything that I spoke about has been presented for you over here as well in a written way to make things easy for you. Next, they've given us the principal budget factor. Some very important considerations are going to be made over here. Now, a principal budget factor for revenue and direct costs is the number of covers. This number of covers is driving the cost. Only if there is a customer, he places the order, dish gets made, server gets included, chef gets included, server gets included. Oh, everything in this business is happening because of a cover or a customer. The budgeted number of covers per year is calculated as follows. Seats per restaurant is 100 times seats are filled 3, maximum covers is 300, days operational 360, 5 days are off, occupancy 85%, budgeted covers per restaurant per year is 91,800. Number of restaurants for this year, 9 full. In July we are opening, so half, 9.5. Total budgeted covers for the year 872,100. This is my budgeted covers, which means based on this, entire budgets have been created. So each cover is a single customer. So 872,000 customers we expect. The budget assumes 80% of covers order a starter. Remember, starter, my most profitable product. 100% order a main, that is why it has the highest revenue. 40% order a dessert, my number 3 profitable. I need to try to upsell this. 100% order a side, it's the least profit for me. 100% order 2 cold beverages. Remember, beverages are a major revenue generator for me, major driver of profit for me because it has the highest margin. And 50% also order 1 hot beverage. These are the notes given to you, and the principal budget factor being the number of cover. Now the cover is explicitly confirmed as SoPa's principal budget factor, the single scarce resource that drives all revenue. This is the definition of a limiting factor. How do we make sure that we utilize our covers to the best possible revenue generating dishes? So maximum capacity is 300 covers, but SoPa only expects to use 85%. 15% is my unused capacity. So opportunity cost, we already spoke about dynamic pricing. The new restaurant that we are opening will have no historical data. It's in the new part of our country. So budgeted covers is based on assumption. If it's based on assumption, then we already know that outside of Tombor our restaurants are not doing great. So there will be a variance analysis which will come into the picture, and also forecasting methods, expected values, sensitivity, more uncertainty around this new restaurant is something that comes into the picture. So okay, now they told us that starters 80% order. So this is something, an upselling opportunity. Every customer orders the main. For dessert, majority skip dessert. Again, upselling opportunity. Sides are ordered all the time. Cold beverages are major for our revenue. And half the customers order a hot beverage. So maybe dessert starters is something where you start thinking of for a dynamic price or an upselling opportunity, because these are high revenue generating products for you. And this we are understanding because essentially we are doing a CVP analysis, cost, volume, profit analysis is being done for you over here. So your mix variances, your sales mix variances, will be very important because this might change according to new policies or new upselling opportunities which you come up with. So if I do an overall summary versus 2020 or 2025 actual to the 2026 budget, it was 41,680. It's now expected to be 49,153. An 18% increase is still expected. For gross profit, you'll see 32.6 becoming 34.9. Revenue per restaurant going up by close to 5% and one restaurant is increasing. Now, one misconception that students may have is just because they've seen the word, let's say principal budget factor, it's driving the cost. The number of covers or a number of customers is pretty much driving the cost. So you're seeing the words, okay, this is driving the cost, this is creating the cost. So a lot of students might straight away, for some reason link this to, okay, drive means driver means activity based budgeting. That is not the case. If it were to be activity based budgeting, they would first have to follow an activity based costing system. If you look at any of the costing information that's been given, do you see the breakdown by activities? No. So naturally, it's not an activity-based costing system and it can't be an activity-based budgeting system. If you look at the information given and the principal budget factor information given to us, it indicates to rather a top-down incremental budgeting system. Because they are clearly saying that, okay, the primary driver is the principal budget factor, which is the number of covers. And to this, they are applying a fixed percentage, which means they're saying, okay, assuming that 80% order a starter. Where did this 80% come from? Maybe after looking at all of these years' data, we have predicted that 80% will order a starter. So pretty much it's set looking at our past data. And this is classic incremental budgeting. So it assumes that the current structure will also apply to this year. The only thing that is changing is number of customers and your number of restaurants. Everything else they are assuming will remain the same from the past budgets which we have created, which is essentially a link or let's say a direction to incremental budgeting. So they have not clearly mentioned our budgeting style. This is just a hint which we are picking up to make you understand why this could be incremental budgeting. And I'm sure you all will now agree with me. So marginal costing we proved, we will further speak about it. Incremental budgeting we gave you an idea about. Now they are giving us each and every product's breakdown. What are my products? My starters, my main, my dessert and my beverages. So each product's breakup has been given to us now. Let's start with starters. When I start with starters, very clearly first hint is they said standards per starter. This is definitely not activity based costing because they said standards. So standard costing is being followed. Under standard costing, you have absorption costing, you have marginal costing. We have already spoken about that, okay, we are using the marginal costing system, but it's even more clear over here. Why? Because they gave you, okay, selling price, they removed the ingredient cost, they removed the labor cost, and then they give you profit after direct costs. So from the selling price, they remove your costs and you got profit after direct cost. So essentially, this is our contribution. From this, they will remove as a block the fixed costs and then you will get your gross profit. Over here, they've given us margin. This is another indication because they have given us margin. If they would have given me gross profit, which is only derived after the direct costs, after the indirect costs, after the after your fixed overhead aspect, all of that if they would have given me, then it would be a link or show to absorption costing. But as of now, very clearly they are only basing all of their standards on direct cost, after direct cost, after direct cost. So essentially contribution is being provided for you and fixed cost is being taken as a fixed element which will be deducted at the end for you to arrive at your profit. Your major decision making is your variable costs, which is ingredient, direct labor costs, like they have given to you over here. All of which are driven, remember, by the number of covers. So essentially, which in starters, so already we know that starters as a full category are the most profitable. But under starters as well, we have different profit margins. The tostadas, first salad, most profitable, then the tostada, then the taco, then the ceviche, and then the special. So essentially, in starters itself, I need to know that my hero is salad. The specials, which keep changing, is the lowest margin product because of its high ingredient costs at $2.4. Everything that I spoke about has been put into words for you over here. So salad is the most profitable. Weekly special, lowest margin because of high ingredient costs. Direct labor costs are relatively narrow across all starters, suggesting preparation complexity is similar. No one starter is more complex than the other starter. The main cost driving differentiator is the ingredient cost. So we should note that customer preference does not always align with financial optimality. If actual mix shift towards specials and away from salads, an adverse sales mix variance will result because salads highest profitable, specials lowest profitable. So we need to make sure that okay, specials are there. So sometimes customers can order it, but they should be more inclined to order the salad because that's where our margin is. So ceviche's position as the highest absolute profit starter is directly threatened by a single supplier dependency of fresh fish. Remember, for fish we have only one supplier. If you look at ceviche, it's going to essentially demand the highest selling price, so highest revenue generated from there and a considerable amount of profit as well. But if my highest revenue selling item, there is an issue with the fish, then naturally the other products the customer will order will take a toll. So I need to make sure that my this is supplier dependency clear situation being given importance over here rather. Next, budgeted revenue for the starters. Now we already know 80% order starters. So we took it at 80%. Starters per year 73,440. The budgeted mix, obviously taking it from last year or the year before that, we are just following that, or maybe we'll add to that if we see a increase or decrease. This is classic again direction that incremental style, simple style, standard style of budgeting being followed. So mix is 20, 20, 30, 15 and 15. So 30% order the taco. Budgeted starters sold. So the highest selling starter is the taco. Ceviche and tostada is the second. Salads and specials is the third. Just what I want you to take away from this is my most hero or my hero product is the salad. It's pretty much the least selling starter. This is something that you can keep in your mind, plug when the time comes. Also, the taco gives me 80% margin. So third highest, after tostada, it's the third highest margin generating product for me. Over here, taco is the highest selling. So essentially in the in the starters zone, because starters as a category itself is the most profitable for me, how do I make sure that this 80% goes to 82, 85% also? It will be a big jump in revenue, in profit for my business. And that's what we will tell you with my analysis. This is the sales mix variance given to you, a very clear indication that the sales mix percentage is given, sorry. So a sales mix variance question, very, very likely. Total starter revenue is 7570 across 9.5 restaurants. Chicken tacos generate the highest revenue at 2093, driven by the 30% sales mix, the highest of any individual starter. Ceviche and tostada 20%, salads and starters 15%. Any exam scenario changing the starter mix would directly affect these revenue figures because it's the highest margin product for you. Only 80% order a starter. So increasing the starter uptake from 80 to even 85% would add approximately 400,000 in revenue, which is a big percentage. So how do I make sure that I can sell more starters? Something that you can think of. Next, budgeted direct costs have been given to you for the starters. These are the costs, remember this. Again, an indication of the marginal costing system will come up for you. So you'll see over here that budgeted starters sold, the number has been given, ingredient costs have been given, direct labor cost have been given, total direct costs have been given, and this is your budgeted direct costs. Simple. Now the direct cost breakdown confirms SoPa's marginal costing approach. Only variable costs, which is your ingredient costs, direct labor, are charged per dish. Fixed costs such as rent, salaries are excluded entirely and dealt with separately as a period cost because you directly cannot control them. They are not related to revenue. They are not related to revenue directly. So what we are focusing on is the direct costs which we can control, which are a major part for my business. Again, a move to activity-based costing to better understand how I can manage the labor costs, how I can manage the ingredient costs, how I can manage my other costs as well, such as marketing, such as admin, because they have also increased, could be on the cards, so that we understand better, we price better, and it's to the eventual betterment of the business. Now considerations, because we use marginal costing and present this way, underpricing risk. Now by only showing direct costs per dish, managers may set prices that cover variable costs but fail to cover the fixed overheads of 20 to 85 that we had seen above. If fixed costs are not factored, we might make a contribution, but overall your business will make a loss. So far everything is going fine, but with new products coming in, with new expansions which SoPa has on the cards, marginal costing might be simplistic, might not work. Next, inventory valuation, IAS 2. Marginal costing excludes fixed overheads from product costs. Under IAS 2, financial statements require inventory to be valued at its full cost, which is indirect, direct, which is variable, plus fixed. So essentially absorption costing, meaning SoPa must or will have to maintain two separate costing approaches for management and for financial reporting, because these are IAS 2 rules. Performance evaluation, presenting indirect costs as one fixed block, 2285 that we saw ahead, makes it impossible to assess the true profitability of each of the dishes. A dish may show healthy 80% margin, but if fixed overhead allocation were included, actual profitability could vary. So these are disadvantages of using marginal costing. There are advantages of using marginal costing as well. You should be very clearly able to present advantages, disadvantages of each costing system. Absorption, marginal, activity based. Because we are using marginal, I have explained that for you through these tables. So okay, just an analysis of the budgeted direct costs. So 80% of the budgets order a starter. We already know that chicken is the most popular, salad is the highest margin, the special starter lowest margin. So from a revenue mix perspective, the highest volume taco and the lowest margin special are key cost management areas for my business. This was my starters breakdown. Only one product. My suggestion is pause the video here. There is a lot going on. I know that. I understand that. Pause the video. Watch starters again so that information jams into your mind, gets stuck in your mind. And by watching it 2 times also, don't expect yourself to become an expert. There is a lot of information and numbers going on. I understand that. Be patient. 1 time, 2 times, 3 times when you go through this information, you will have very clear direction. And I will, give you multiple opportunities to try this, test this within our mock questions as well. So don't worry. Here you are only understanding our company first. Now we have mains. Starting with standards. So same breakdown we did for starters, we will do for mains also. Now the standard per main has been given. I will also again look at the most important things, which is my highest selling price, which is steak, but highest profit is veg. That's what I want to take away. Highest selling price, steak, so highest revenue generator, but highest profit generator is veg because it has a margin of 81%. So the vegetarian bake has a highest margin at 81%. This is significantly cheaper than the next lowest fish at 3.10 in terms of the ingredient cost. The weekly special carries again the lowest margin. Why? Because ingredient costs are very, very high, 5.40. Since the special accounts for 30% of all the mains sold, its cost management is critical to maintain good profitability. So the mix along with the margin needs to be considered. What is selling and what is more profitable? These are 2 things you need to keep in your mind. I will also give it to you, but I feel that you should be creating also just a small mind map. In starters, which is the most selling and which is the highest profit. In mains, most selling, highest profit. Same way you'll do for dessert, same way you'll do for sides, same way you'll do for beverages. Just simply knowing, okay, this is highest selling, this is margin. Highest selling, margin. What is the highest selling? What is the highest margin? Just try to know that for your product so that mix remains in front of you till the date of your exam. The vegetarian bake has the highest margin at 81%. The weekly special carries the lowest margin. The steak chimichurri gives the highest absolute profit per unit or highest absolute profit after the direct costs. But if you look at the margin, it also has the highest ingredient cost. The spread between the cheapest main to produce and the most expensive is 4.52, nearly double. So I want to look at which is the, again, like I said, just create a map, which is the highest selling in terms of revenue and which is the highest margin that's giving to me. So as a business, that's what I want to understand. Because if you see, for veg, out of 15, my profit is 12.22. So per veg sold, that's a very high profit margin which I'm earning, right? That's what I'm trying to point out over here with the margin. But otherwise the profit, if you look at per unit, then the highest profit generating is steak. But look at the investment of ingredient costs. Look at the selling price that you are charging. So comparing all of that, the margin for veg is the highest. Same budgeted revenue now for mains. This is the revenue that we are looking at. So mix 20%, 20%, 20%, 10% are only going for the veg. big question comes up. Only 10% are going for the main, but is growing in importance giving customer trends. It has a low selling price. It limits its revenue contribution, yes, but it has the strongest margin of close to 81%. So can we sell the veg more? Something for us to look at. So steak chimichurri generates the highest revenue, but it's only 20% of the mix. So if we could have 2, 3, 4, 5% more customers, even for the steak chimichurri or for the veg, that's going to have a revenue impact. That's going to have a margin impact. Revenue impact for chimichurri, margin impact for veg. Now, all of this you are only understanding because you are doing these discussions with me. Otherwise, how are these ideas even going to come to your mind? Next, budgeted direct costs for the mains. So now the costs for the mains. We obviously know that the highest cost is going to be for the steak because of its large investment, but the special leads again highest ingredient cost, then comes the steak, then coming chicken, then coming fish, and veg is only at 25,520. So 100% of the covers order a main. Remember this is the backbone of your food revenue. The weekly special is the highest volume dish at 30% of the mix with the highest absolute revenue. But is it the highest profit generating? Just quickly look at it. Going back to the first page. No, it's the lowest profit generating for me. Highest revenue, everybody orders it, but it's the lowest profit generating for me. The vegetarian bake carries the highest margin at 81%, yet it represents only 10%. Significant opportunity. The steak chimichurri generates the highest revenue. In terms of revenue, it's the highest at $25. And the highest profit also at $17. But it carries the highest ingredient costs. The special main has the lowest margin at 67%, given it is the highest volume dish. Even a small reduction in its ingredient cost or a price increase would have a very significant impact on your total profitability. So essentially, this is where your tight handling of costs will have to be, because everybody is ordering a main. Next comes your sides and desserts. While I'm looking at sides and desserts, these are important for my business. Sides, you have tortillas and dips. For desserts, you have dessert and ice cream. So highest generating margin is ice cream, dessert next, dips and tortillas are pretty much the same. So essentially, desserts, if I'm mapping it out, under desserts, ice cream, under sides, both are the same. Analysis of the above table quickly. Tortillas have the lowest margin of all food items at 60%, driven by high direct labor costs. Dips direct labor cost is also the same. Dips are marginally better. These are the weakest margin items across the entire product range, but everybody is ordering a side. We need to offer them. In contrast, ice cream carries a strong 77% margin thanks to its very low direct labor cost. There's no labor cost, you just have to plate it. You make it once, it's made in the machine. Plate it and give it. The plated desserts are 70% margin. For exam purposes, the tortilla labor cost is a key variance analysis target because these are low margin generating products for you. Trying to increase the margin here, trying to further understand the costs to make sure that we cannot, in any way let the margins dip more. Otherwise, it's a complete loss, waste of time for the business. Next, we have sides and desserts. So for sides and desserts, budgeted revenue now. Just I'll look at see, there are a lot of numbers. You need to isolate yourself to the important numbers. Let's look at the mix. 100% is ordering a side. For desserts, essentially, for sides, overall, what we want to look at is the number of items sold. So budgeted sides or desserts sold. 183,000 for my sides and 36,720 for my desserts. I want to make sure, or I want to try to understand how I can sell more, how I can make sure that I can sell more so that people are more inclined to buy a dessert. People are more inclined to go for a dessert because these are big profit generating items for me. So desserts have an upselling opportunity which we have already spoken of, which is clear from this table. So desserts revenue totals 2512. At only 40% attachment rate, desserts represent the biggest upselling opportunity. Each additional 10% increase is going to generate huge profits for me because these are high margin generating products. So how can I upsell? How can I ask people to go for a dessert? That's going to be an analysis or a direction that your business takes. Now for the costs. Now if I look at the costs, the total direct costs, the highest, or rather the out of sides and desserts, the highest direct cost is that for a dip, then a tortilla, then a dessert, then an ice cream. So my lowest cost product is giving me the highest margin, obviously because cost is less. So what I want to look at this and understand is I need to offer sides because they go with my let's say restaurant's theme, they are needed, but I want to try to upsell my desserts because that's where I am making my profits. So sides are ordered by 100% of the covers, creating high volume and a reliable income stream. You need it. They are lowest margin. Ice cream is the most profitable. Offering ice cream promotions or upselling desserts could be a situation that we look at. Next, same way we have for beverages. Remember, beverages are the most profitable revenue, or rather highest profit generating category for me. Standards per beverage has been given. For cold and hot, margin is 84 and 76. So essentially, these are huge margins. Cold beverages carry 84% margin, highest of any product category. Hot beverages have a lower margin at 76% because there is a direct labor cost getting involved. The stark difference between beverage margins and food margins. Food margins range from 60 to 87. These are 76 to 84. So the base is only 76. Makes beverage performance a critical profit driver. Anything which affects your beverage performance will have an effect on your overall profit because these are huge profit generating areas for me. If you look at the budgeted revenue for beverages, it's coming up to 17,442 and the costs are only 2,856. Negligible because obviously you're just preparing them and providing them. So beverages represent 35% of my total budgeted revenue and carry the highest margin. This makes it the most profitable product line which you need to take care of. Cold beverages dominate, accounting to majority of the let's say revenue. The beverage consumptions, 100% cold and 50% hot, are critical budget drivers. If the hot beverage consumption from 50 even goes to 60, 55 also, it will have a big effect on my revenue. So high value upselling opportunity for a beverage, hot beverage, for a starter, for a dessert, especially ice cream. All of this we are only understanding because of this analysis which we are doing together. Now they've given us restaurant running costs. The cost of running your restaurants. This is again very clear direction that marginal costing is being used. Now this includes the cost of all restaurant managers and front of house employees. It also includes all premises and equipment costs such as rent, depreciation, energy, insurance. It is estimated that 40% of the total budgeted restaurant running costs are variable and vary in the proportion to the number of covers, and the rest is fixed. So 60% is fixed. Your fixed cost variance also becomes important, because if these change for any reason, it's going to have an effect on your profit. So variable is only 40%. 60% is fixed, which is very natural for a restaurant who has property, plant and equipment, who has spaces, who has people, staff, 31 people per restaurant. The standard variable cost per cover is therefore 9.30. They took the total variable cost, they took the total covers, divided it. 9.30 is your standard variable cost per cover. So 8114 divided by 872,000 covers, 9.30. This is a new cost driver separate from the direct costs per dish already seen in the standard cost cards. We already know your direct cost per dish, which includes your ingredient costs, your labor costs, but essentially your major principal budget factor is all based upon the number of covers. Total variable cost per cover is equal to the direct costs plus 9.30 running cost. These are running costs. So your total variable is coming up to your ingredient cost plus your running costs. If actual covers fall below the budget, the 9.30 saving per cover lost is the relevant cost saving. This 9.30 is your relevant cost. If covers go up, covers go down, this 9.30 is the decision making cost which you will be, let's say, using for decision making. For example, if demands fall, the avoidance saving is only 9.30 per lost cover, not the fixed cost. Fixed costs are any which way is going to be charged for you. 12,171 is the fixed costs which must be covered regardless of covers served. Per restaurant, this is going to be 12,171 divided by 9.5, 1.281k fixed costs per restaurant. Per day, per restaurant, the fixed cost comes up to, divided by 360 working days, 3558 fixed costs per day. SoPa incurs this whether the restaurant is full or is empty. This highlights the importance of occupancy. Every cover above break even contributes directly to profit. So once your fixed costs are covered, automatically everything is then going to profit. So making sure occupancy is something that we really focus on, for which we have made a contribution and break even analysis for you. Now budgeted revenue per cover. Total revenue divided by the number of covers, $56 you expect to earn from each customer stepping into your restaurant. The direct costs are only 13.42. The variable running costs are added. Contribution per cover. So your budget minus the direct costs, which is your food and beverage, minus the 9.30 gives you your contribution, 33.64. Out of this, the total fixed costs are 12,171. So break even covers is 12,171 divided by your 33.64, 361,800 covers. You expect to get 872,000. Your break even is only at 361. Everything above that is going to be your profit. So business is in good position. The margin of safety currently is 58.5, which means your covers can fall by 58% until you start making a loss. So you still have very significant room. If something goes wrong, you can correct it and you'll still make a profit. So business is not in that critical decision making zone right now because it's stable, been in the market for a long time. So the approximate break even of 361,800 covers represents 41.5% of the budgeted covers. So margin of safety is 58.5, meaning actual covers could fall significantly below the budget. You have a reasonable buffer. So yes, if you take any risky decisions like a dip, like your vertical farm, like your expansion, you still have a buffer where you can try it out. If it works for you, if you manage it well, business will only go ahead. You have the cash, you have the money, you have strong financials. If it doesn't, you still have a good amount of buffer before you start making a loss. So this is my analysis of the financials created. Last section is the news analysis section. Always the news analysis section is the last 7-8 pages. I have created the entire synopsis for you and I have created my analysis. So synopsis, analysis, synopsis, analysis, synopsis, analysis, and the last one comes to the tax regime. So I always, for the news analysis section, what I ask students to do is go through the news analysis section. I want you to read it word by word by word from my pre-scene. That is why I am not going to go through it with you. But when you go through my synopsis and then the analysis, everything will be covered for you and we will obviously be doing mock questions on this. Now the news analysis section is very important because they often pick up themes from the news analysis section and make it a theme in your question, which you can also expect in the exam, which you can also expect in my mocks. So don't feel like, oh, this is not being done, so it's not important. This is rather very important. That is why I first want you to go through it and then I'm going to test you on it eventually. So synopsis is ready. Read it, understand it. Read it, understand it. There are 3 articles which you are supposed to cover. Last, they've given me tax regime. This is very important because it links to your direct F1 syllabus. There are some standard things and there are some things which I want to discuss. So standard is, they told you that the tax rate is 25%. We always know that the expenses allowed for depreciation and for tax purposes are different. Over here they said that the following expenses are not allowable for tax purposes, which means while calculating your tax, you cannot remove accounting depreciation, amortizations, donations, taxes paid to other bodies. Otherwise you'll tell me, okay, my profit is 1 million, but my depreciation from my plant is 1 million. So my profit is 0, I am not paying any tax. Is that fair? No. So for tax purposes, government has different accounting rules, amortization rules, impairment rules, no donations can be removed from your profits. These are tax rules. So this has been given to us, which is standard. Tax depreciation allowances are available on all items of plant and equipment, including computer equipment, at a rate of 25%. So essentially they are telling me that you can charge 25% reducing balance depreciation on your plant and equipment, including computer equipment. Only that much is allowed. If you say that for accounting purposes it's 30%, fine, that can be for your accounting purpose, but for tax calculation has to be 25% reducing balance. A full year's tax allowance is available in the year that the asset is acquired. If you acquire the asset even in the middle of the year or at the end of the year, the full year's tax depreciation is given to you. Why? This government is doing to encourage people that, okay, buy more. buy more. So the economy keeps moving. The government is helping businesses. Even if you buy kitchen equipment at the end of the year, you will get the full year's tax depreciation allowance at 25%. That's what they're telling you. Tax depreciation allowances are not available for property. It's only available for plant and equipment, including computers. Not for property, because property pretty much appreciates. Tax losses can be carried forward indefinitely to offset against future taxable profits. For a very simple example, let's say you start a dips business today. In SoPa itself, you start a dips business. Just giving you an example. Or let's say ghost kitchen, SoPa branded dips or vertical farms, and incurs losses in the early years. These losses can be carried forward indefinitely to offset future taxable profits from the same business. So if we set up a ghost kitchen delivery service and incur losses, so 200,000 loss from ghost kitchen setup, no tax paid, loss carried forward. If next year you make a profit, 150,000 profit, fully offset by carrying forward the last year's loss, no tax paid. Third year you make a profit more, 50,000 was remaining, so you will pay a tax only on 250,000. So this matters to us so that you can take risks. Government is again helping you. Particularly relevant for dips, retail venture and the ghost kitchen, both requiring upfront investment. Remember, loss carry forward only applies to the same business. If you set up a separate legal business for dips, for ghost kitchen setups, losses cannot be offset against restaurant profits. You can't say that in one company I made a loss, one company I made a profit, so I will offset these both. No. In your business itself, in one business itself, the losses can be carried forward. That's rules which are being provided. And the sales tax, simple, is charged at 20%. You are supposed to collect it from the customer and pay it to your government. You will also be paying this yourself when you are buying ingredients. So essentially this will net off for you. I have given you examples like I just showed you for the ghost kitchen. I have given you examples for tax depreciation allowance, what it means. Already explained it, but I've given you an example. Given you an example for losses. And that brings me finally to the end of this marathon pre-scene analysis. A lot going on, a lot of important numbers, but these are important because CIMA generally releases a 25-26 page pre-scene. This time they have a 35 page pre-scene. That is why my analysis has gone up to these many pages. Otherwise my analysis is shorter. They have given us information, so it becomes our duty to deal with that information so that we are well aware and use it when the time comes. So be very sure, certain of your prep on the pre-scene and only then move on. No hurry. For any questions, please feel free to reach out. Thank you.